So moving averages at a metric level, but also looking at multiple metrics that are telling you the same story, which again, the dashboards, if you're looking for which metrics should I care about, dashboards. Okay. There's a question here about weekly training. So maybe not weekly training, but certainly we are in the process of, the reason why this webinar exists is that we're trying to make sure we've got training coming out. There's a couple of things that we're working on in the background that will be a bit more kind of structured. You saw some of the topics. Now that we have our dashboards released, we're now going to start turning those into a bit more educational content and saying, all right, on-chain activity, let's understand why that matters. Profit and loss, let's understand why that matters. So to answer your question, there will be more stuff coming out. It will be coming out as quickly as we can ship it, which, most of the time there's something coming out each week. But we will be structuring that into a more tight process in the very near future. So stick around. Okay, what do we got? Last question I can get around to. How do I reconcile this with macro market forces? Great question. One that I get quite often. So there's a few ways I can answer that. The first one is understanding the macro. And again, my background is civil engineering. I just happen to have a passion for markets and obviously for Bitcoin. Macro market factors, I spend a lot of time personally just studying and understanding it, right? I'm no macroeconomist, but at the very least, I reconcile it personally by just being aware of it and understanding it. But if we actually peel back that onion one step lower, I think we would probably all agree that Bitcoin entered the world of macroeconomics back in 2020, 2021, rightly or wrongly. How it did doesn't really matter. I think it emerged into the consciousness of the Wall Street world as a macroeconomic asset. So as a result of that, and actually, I wouldn't even say as a result of that, before that as well, for me, I got really into Bitcoin. It was kind of what I kind of woke up to it in very early 2019. My behavior in the Bitcoin space personally, as a hodler, as a long-term hodler, was because of the macro environment. So my decisions and my observations about what's going on in the world, they are imprinted on every single UTXO I've ever touched, right? Did I buy that day? Did I sell that day? Did I hold it? Did I not? Did I spend it? Did I move it out of exchange? What did I do? Everything that I did, every decision that I did is inside the UTXO set. So there's many people like me. There's also many people who just came for the hype, bought, sold, get me out of this thing. All of those decisions are collectively contained within the UTXO set. On-chain analysis is pulling that database and turning it into information. So when you ask, how do we reconcile this with the macro market factors? What I would actually return and say is that all of the collective decisions of the hodler cohort and the speculator cohort, and in fact, any person who's ever transacted on-chain with Bitcoin or hashed, all of those collective decisions are contained within the UTXO set. So in a way, it's self-reconciling because the data and the way that people behave regarding Bitcoin, the asset, because what the data inside the Bitcoin blockchain is telling us, it doesn't tell us anything about the oil market. It doesn't tell us anything about Apple stock. What it does tell us is how people behaved with respect to Bitcoin with all of the macro information around them, right? We are all creatures who live inside a society where things are happening all the time. There's macro, like my macro environment here over in Australia is different to yours in the US, which is different to yours in China, right? The overall environment that we live in affects our personal decisions. And those personal decisions are getting baked into the Bitcoin blockchain. So in a way, it's somewhat self-reconciling because the way that Bitcoin is being treated in response to the information and the stimulus that human beings are exposed to, that's essentially what creates the on-chain data set that we have in front of us. So anyway, I think that's pretty much all the questions we've got here. Thanks again, everyone, for tuning in. I really hope that this was a useful session. As I mentioned at the start, we will be condensing this thing down into we'll have a recording for it. So if you do need to come back and refer to it, you will. We will put this particular webinar session inside a video, which will go inside that first dashboard that we had. And it will have backlinks to all of these things. If any of this stuff is kind of intriguing, do feel free to reach out, jump into forum. As I mentioned, everything here is available with an advanced plan. The big takeaways I want you to take away is 1, it's all about human psychology. 2, categorize things out. On-chain activity is for X, profit and loss is for Y. Categorize things out and it will help you along the way. And to help you with those processes, these dashboards is essentially where me and my team are compiling and putting the charts and things that we care about and that we use day to day into those dashboards to answer those specific questions. Anyway, that's how we'll kind of wrap it up. But hope everyone had a great time, and we'll hopefully be doing this again very soon. Cheers. Hello everyone, and welcome to your Glassnode video report for week 6, 2023. So we are looking at the shifting market tides. We've seen obviously a pretty spectacular rally through January. The market is currently consolidating, and as we've talked about over recent weeks, Bitcoin price has really jumped above several key cost bases that we track on chain. And what this really does is it introduces a dynamic of realized and unrealized profit and loss that we haven't seen really, because it's been a bear market and everything's been losses. So we're starting to see a bit of a transition towards this realized and unrealized profit. And I want to explore both of these because the concept of realized and unrealized profit and loss are, in my view, some of the most powerful elements in all of on-chain analysis. And it certainly forms the bread and butter of a huge part of my own personal analysis. So I'm really excited to take you through this toolkit and explore what's going on in the shifting tides. So generally speaking, when you come to some of these transitional markets, and I'm thinking like along the lines of 2015 and 2019, it's very rare for a bear market to just end and it all kind of turns around and goes the other direction. Generally speaking, there is this process. I mean, if you look at the 2019 and 20 period, even if a bottom did get put in, we spent another year and a bit trading volatile and sideways all the way from the bottom at 3,200 all the way up to 14,000 and then back down in March 2020 to 3,800. So these processes take a long time for markets to turn around if that is in fact what is going on. So what we're going to look at here is how we can really map out, is this transition really in play? Are we seeing this transfer back into a profit-dominated regime? As the market rallies, more people are going to be holding coins in profit, and therefore people are also going to be able to take profit. So we're going to really explore this from two different angles, primarily the realized profit and loss. When we talk about realized profit and loss, these are coins that people are spending. It's the actualized, somebody accumulated a coin at 16,000 and is now spending it at 23,000. That would lock in a profit. And the guy who bought his coin up at 60,000 and is currently selling down at 23,000 is realizing a loss. Now, the unrealized portion is the other side of that equation. They're coins that have been accumulated, whether higher or lower, and are held to this day. So they haven't actually locked in. It's kind of a paper gain or a paper loss. So we've kind of got four quadrants: realized, unrealized, profit and loss, and all of these can be used to describe the overall behavior. So we'll look at this in terms of the components, and then we'll also distill these concepts down into a series of macro oscillators, many of which we're starting to return to what is mathematically and statistically a equilibrium point. So we'll talk about this in a second. As usual, before we get started, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And we are going to be continuing with our full-scale chart mode this week. So, and we're also going to be going dark mode. I saw some comments there saying, please go dark mode. So again, we're always iterating, trying to find the right balance. So please let me know if you enjoy this full-scale chart view. And also give me the thumbs up, thumbs down for dark mode. Let's get into it. Okay, so we are going to start very simple with the concept of realized profit. And as you can expect, the next thing we're going to look at is realized loss. So when we talk about realized profit, this really is a bread and butter metric. It's something that I use all the time. This is looking at the US dollar value of a coin that is being spent. So all of the coins moved that day, how many of them were in profit and how much were they in profit. If somebody acquired their coin at 10,000 and then sold it at 20, and there was equivalent to half a Bitcoin, then they're essentially looking at that $10,000 difference times their half BTC, $5,000 in profit. So it's fairly simple calculation. When was the coin acquired? When was it spent? Check those two prices and then multiply it by the coin value. And then that exercise is performed for the entire market so we can see how much profit the market is locking in. So you can clearly see the bull market stand out. Both 2017 is an enormous And by the way, this may look exciting. Lots of folks look at these very, very high peaks and say, look, that's bull market material. Actually, that's people taking profits at the top. And as you can see, we had a multi-year bear market that followed. So very high values of realized profit, like here in January and here in February, are actually signals that coins that were last acquired at much cheaper prices in high volume are actually being spent and likely distributed. So these very high peaks is kind of looking for that counterintuitive view. And also, here's another big note. You can see this massive structural triangle over the last 2 years. Really, the peak profits being locked in was back in the early phase of this bull market. And note that the all-time high we had in October and November, this is a really important concept. This is a big bearish divergence. The market pushed to a higher price, but it was absorbing less profit. There was less demand, even though the price was higher. So the same can be seen if you look at on-chain activity, if you look at MVRV, which is the unrealized profit. There's lots of indicators that had this large structural triangle or a descending line across these two different peaks. We had less momentum, less oomph, less people coming in as demand, less profits being taken, but that was still enough to reverse this thing into a year-long plus bear market. Now, what we can see is a minor uptick of what's going on with our recent push up here in realized profit. This is the highest level we've seen since really June 2022. And this was, even though this was a capitulation style event, we see people actually come in and sell their coins at a profit because they're still panicking. Capitulation can also include profits. We generally see an uptick, but naturally much, much less than what we see during capitulation style events. So it can kind of give you a bit of a gauge that we've seen this large scale compression triangle and we've seen a minor uptick. So this is just something to say, all right, there's more profits in the system, but also let's look at it in terms of scale. It's really back to 2020 levels, it's back to 2017 levels, and prices were much, much lower back then. So we are talking about a substantially lower degree of profit that is currently being locked in. So it's small on a relative scale. So if we now move along and look at the realized losses, this is obviously the other side of the equation, we can see that this has gone through a period where we saw peak losses initially on that first major sell-off in May 2021. So we can see a significant sell-off down here, which actually created that kind of initial impetus and kind of broke the bull market spirit. We then saw that this started to form a plateau with several large-scale capitulation events, both in June 2021, in May, in June, and then again you can see FTX stand out. So realized loss will tend to peak when you see these enormous flush outs. We can see here again that we have March 2020, we can see that we have the November and December 2018 period, and also note that realized losses are a great indicator when you see a bear market starting. Here we are back in 2018, we saw price fall off that $20,000 peak with some gusto and an enormous uptick in losses. People who bought the top are capitulating out at that point in time. And you can see that this was really the same event that we had back here in May. Now, what you can also see is that this, over recent months and through the FTX disaster, has started to really cool off. So we've seen realized losses start to decline quite significantly. So now we've got a situation where realized profits are up and realized losses are actually down. So we're going to explore this in a ratio now. So this model is the realized PL ratio, or realized profit and loss ratio, and it's literally taking the ratio between how much realized profit is in the system and how much realized loss is in there. We can read this thing in a similar vein to the way we look at popular metrics like SOPR. Very, very similar in the concept, in the sense that when it's down below a value of 1, you have more losses, above more profits, and obviously the larger in scale. Except what this one here is doing is comparing the global USD value in a ratio. Whereas SOPR is looking at a per transaction basis, therefore you're going to have shrimps the same weighting as whales. It's kind of across the whole market. Here we're actually looking at dollar value compared to each other, and you can really see this picks up large scale macro trends, both bulls and then down into bears. You can also see here's that 2017 top. Look at the massive and dramatic decline from the top. We went from a all is well, happy days, profit time to a very, very quick and sharp move down into losses. So really that sharp move down, we can see it here in 2013 on both peaks, and we can see it, in fact, you can even see this declining as we came up over the top here in this February through to May peak in 2021. What we will just do, I'm just going to grab this, the exponential moving average here, and just put it on a 30-day. just really take some of the noise out of it, and you can really start to see those dramatic declines. So you can see where this 2017 peak came in, you can see where the May peak came in. Typically these structural declines of dramatic scale indicate that we have transitioned into a new regime. Now, let's put that into the opposite light. We're now looking at this from a bear market perspective. So if a large sharp decline in overall profits means that we are likely transitioning towards a bear market, then these very sharp upticks off the bottom and we move back into profitable territory, typically after a long and sustained period where everyone is just getting locked in losses, here we're seeing a massive push higher where realized profits are now starting to dominate. So it's kind of one indicator that we may well be moving back into a regime where people were able to realize profits. There is a bit of demand coming in to actually absorb that profit taking. And as I've said in previous videos, and maybe your experience is different to mine, but I very rarely hear my friends come in and say, hey, I'm having so much fun losing money in this market. It typically is the other way around. So generally speaking, assets tend to get into a bit of a cycle. That's why we literally have cycles. So this is at the very least an early sign that we are now in a regime where profits are being realized more than losses. But remember, it's not clear sailing. Here we are in 2015, we had an entire year of chopping sideways. So in many ways, this has a lot of semblances to the 2015 era, which was 12 months of just sideways pain. And then the 2019 era, which was euphoria, followed by another 12 months of sideways pain, and then the March 2020 event. So it is not a clean sailing here. We are just looking at the turning of the tides, but these things tend to take time, at least based on the few data points that we have through history. Now, putting a lot of those ideas together, and this is actually a workbench chart. So under workbench, you will find that we have a whole suite of these pre-built customized sets here. So these ones are under the profit and loss category. And for these ones here, I've actually changed and put a 7-day moving average on there. You'll see here with the profits, it can be quite noisy if we're looking at it on the daily basis. So sometimes I like to just put a 7-day moving average on the realized profit and realized loss, and we can just see the overall picture of this thing. So what we're basically doing is taking that realized profit and realized loss, putting them together on the same chart where one is positive, one is negative, and we can see the FTX flush out, we can see the June flush out, we can see the Lunar flush out. You can see these major capitulation events stand out quite clearly, and they generally precede some kind of market reversal or at the very least some kind of consolidation. So these large flush out events typically signify a bit of a regime change themselves. Same as market tops. These large peaks in profits typically signify that there is something starting to change. Here's the October-November peaks. Something is starting to change when you get lots of people taking profits. It means you need more people coming in and more demand. And if the demand isn't backed up by on-chain activity or many other metrics we can kind of measure this by, yeah, you start to say maybe it doesn't quite have the legs. Now, where we are at the moment, here's where we can see that our profits have ticked higher than our losses. That's the first observation. We've seen this in our net and the PL ratio. But the other thing I want you to take home here is when you look at this chart, the scale of these two is really not the thing that stands out. They're pretty small in a relative scale. So really, it doesn't really look like either a bull or a bear market, which again gives us that indication that perhaps it's a bit more of a sideways, choppy, boring, transitional period. Again, we can always observe this data as it plays out, and we can start to look for signs that maybe there's more losses starting to creep back in, and that would indicate the top buyers are getting out. Or we see more and more profits, which says people are taking a bit of a cautious view and starting to exit. So again, it's all about looking at the rate of change. How do these metrics transform over time, and what does that tell us about investor sentiment? Now, I mentioned that they're fairly small in terms of total realized profit and loss, and that is true. What we're looking at here is another workbench preset. This one here you will find under market indicators called the sell side risk ratio, and the next one we're going to look at is the realized RVT ratio. These are both using the same concept. We've got an amount of realized profit and loss, but how big is that relative to the market? Is that a large amount compared to how large Bitcoin is? So what the sell side risk ratio is looking at is how big is Bitcoin? Right? How large is the asset? And we measure this via the realized cap. Then what we're saying is how much profit and loss have we got? The total dollars that are, kind of think about this like the payload. How much is actually being locked in by the market in either profit or losses? So let's say we have $1 million in profit and loss combined, but the market size is 400 billion. Then that million, it's, it's probably big to you and I, but it's nothing compared to the size of Bitcoin. That will return a very, very low value. So typically we see these low values in quiet, low volatility, not much going on. Post FTX, just before FTX, FTX was not one of those events. We had a large payload relative to the market. And then afterwards, we went for a very, very quiet December. We saw this right before the November sell-off in 2018. We also saw it right before the rally upwards. So this is not telling us anything about direction. It's telling us, when does the market go to sleep? There's not much happening relative to market size. So it typically signifies that we're at a bit of a transitional point, and that can be in both directions. But typically low volatility, back here in 2015, low volatility tends to precede high volatility, and high volatility creates more realized profits and more realized losses. So this is a bit of a looking forward. How large is the current realized value relative to the size? If it's not much, it's a low volatility, quite quiet environment. Generally speaking, that precedes a period of much higher volatility. Now, that previous metric was comparing the realized value to the market size, right? How big is it relative to Bitcoin's realized cap? Well, we can also look at this in the sense of how big is it relative to the transaction volume. So there's an amount of value flowing through the system. Imagine a day where you've got, 1,000 Bitcoin that are on the move, and each one was last acquired $1 at a cheaper price. The amount of transaction volume is 10 BTC, or 1,000 BTC, sorry. But they may be realizing like $10 worth of realized profit and loss, which is like, who cares? $10 distributed over 1,000 BTC, it's kind of small. But what happens if those 1,000 BTC were Satoshis and they were locking in a profit from way back where we didn't even have a price, and they're currently locking in an enormous profit or an enormous loss? So this model is essentially comparing the realized profit and loss to the transaction volume. High values means that you have a huge amount of that happening. Again, cycle transition points. Here in February or January 2021 really was the peak in a great many metrics. It kind of showed that's where we saw the massive expulsion of all of the transactions. FTX, also one of these events. November 2018, one of these events. March 2020, one of these events. This model really helps us find periods of extremely low volatility and extremely high volatility. And when you see these extreme points, they also tend to correlate around a shift in psychology. People get completely blown out during a capitulation event, and then the dust settles and things are a little bit better and things start to get into a more healthy system. Or at market tops, you see stacks of people selling all of their coins, taking enormous profits. That first sell-off comes and you get just a flush out, a complete wipeout, and the bull market psychology is taken out the back. So what you start to see is these turning points come with low and high volatility, and these two tools can help you try and identify those big picture macro turning points based on these high and low elements. And by the way, all of these have very, very robust descriptions for them. And again, if you have any questions whatsoever, you can always ask me in the comments or anywhere that you can find me. Okay, so now we're going to move on and look at some cyclical momentum oscillators and just kind of where the market is. And, how do we tell whether we've returned to some kind of equilibrium? What does a turning point look like? So the model that we're looking at here is looking at the unrealized profit. Think about this: at a bull market peak, everyone's in profit. Every coin that they're holding at the all-time high, everyone's in the green. At a bear market, it's the exact opposite. There's basically no one left who's in the green. Now, what happens is when you get to late stage bear markets, as we can see back here in 2015 and 2018, we typically get these big rounded bottoms. And what happens here? Price really towards bear markets 2015, it was 1 year just chopping sideways. Here back in November, December 2018, we chopped sideways for like 6 months. Back here, post the June event, I'm going to use that as our baseline, including the FTX. We essentially went from June all the way through to January. So it's like 7-8 months where we just went sideways and did nothing. During those bottoms, top buyers are capitulating out. They are selling, they're distributing, get me out of this thing. Their unrealized profit gets locked in, their unrealized value becomes a realized loss. I'm taking the L, I'm out of this system. Someone else bought those coins, and then price goes $1 or $0.01 above their acquisition price, they are now in an unrealized profit. So what we see is that during those big scale accumulation periods, this metric will start to reverse and form this nice rounded bottom. Especially, look at 2015, sideways in terms of price, but curling upwards. More and more people were coming back into a profit, even though price didn't go anywhere. Back here in 2018, price went from like 3.2k to 4k. And look how many more people started coming into profit. The momentum of profit was climbing. Here we are, here's June. So even including the FTX, we saw that even though price went sideways to down, more and more people were returning to profit. And then what you'll also note is these very violent explosions back to the upside following each of these bears. These are these cycle turning points. It's showing that we're getting back into some kind of regime that at the very least, it doesn't have the same characteristics or properties as what we saw back in the previous bear market. And this is driven by the fact that coins have changed hands. There is a new ownership structure. New people hold the asset, and the people who were going to capitulate have capitulated. And you're now into this situation where psychologically, financially, behaviorally, it's a different space, and we therefore have to start thinking about things from a slightly different lens. Now, we also have a really neat tool here called time below current value. So what we're doing here is saying, okay, what is an equilibrium level? Because you can see by the red line, it kind of visually looks like it's in the middle. But we can actually mathematically show this, that 54.5% of all trading days have seen a lower value. So, 5% between friends, who really cares? We're about halfway. We're pretty much in the middle. This is the line where, typically speaking, bear markets spend their time below it, bull markets spend their time above it. So we are literally at that equilibrium point. Now, remember, as I said earlier on, all this is telling us is that the regime looks like it's changing. This was the same regime as 2015, which was a year of painful sideways chop. This was 2019. A rally into another year of painful sideways downwards, and then March 2020. So it is not telling us that the bull market is back. All it's telling us is there has been a change of ownership structure, and therefore it makes sense to pay attention to these markets as potentially in a transitional period. Right? So when we're looking at this compared to previous cycles, investor psychology is a bit different, the ownership structure is different. It's different. It looks different to 2022, and therefore we can kind of start looking at things with that in mind. Now, on a very similar model, we have here the adjusted reserve risk model. So this one here is very, very similar in concept, except it will trend higher when hodlers are spending and trend lower when hodlers are hodling. Now, it may surprise you, but during bull markets, hodlers are actually the ones who are doing all the distribution and the selling, because they're acquiring coins in the bear market, they're sitting tight for years on end, and then when the bull market finally comes around, they start distributing. So this particular model, higher values basically indicate that the smart money is starting to distribute. Low values is the opposite. They're actually saying, well, I'm willing to weather this pain and this volatility and this downside because I believe in this asset. So low values typically signify that you've got more hodling going on. And like previous cycles, you'll see that this rapidly declines. Following bull market peaks, in fact, look at this. Look at the November to October. Talk about a bearish divergence. This thing didn't even show up. So it just again shows you that this whole thing, when we come to the October-November event, really just didn't have any legs whatsoever. Now you can also see the blue curve. We're pretty much dead smack in the center of the line that defines bear markets. 2019 poked its head up, but it wasn't ready, pulled back down into bear market territory. We can see here all of 2015 was testing and testing and testing, and it was only that final rally near the start or near the back end of 2015 that kind of pushed us above. And then we moved into a second phase of accumulation and uncertainty. So here we are poking our head up against this middle level where 54% of all trading days have been below. So again, we have pretty much returned to an equilibrium level where half the market is seeing days below this and half the market is seeing days above. So overall, it really looks like a transitional period. The psychology has probably changed compared to 2022. Certainly the ownership structure of coins appears to have changed. There's been a combination of realized losses, which becomes somebody else's realized profit. And this is just how cycles move. It's just kind of nice. With Bitcoin, we can actually visualize and look at these things in almost real time. So thanks everyone for tuning in. Hopefully you enjoyed that session. That was a bit of an interesting gauge on how quickly things can start to move and start to transition towards a new psychological regime. Now, I really do encourage you. We have rolled out a realized profit and loss dashboard. This thing contains pretty much all the metrics that we covered today. So I do recommend checking that one out. It will be in the description below. This is one that I use all the time. And we also have an unrealized profit and loss. So if you're looking to learn either of those two, do check the description below, and I will see you in the next one. Cheers. Hello everyone, and welcome to your Glassnode video report for week 8 2023. So we had a bit of technical difficulty last week, but we are back into the swing of things this week. We're going to be looking at two very interesting topics. When we looked at it back in week 6, we were talking about how the market was at a bit of a equilibrium point. It had returned to a level where many oscillators were around that 50% type mark. And that really told us that we'd kind of reverted back to at least from an on-chain perspective, something that was a little bit closer to a mean value. Now, with that generally comes a change in investor behavior. People have clearly seen a 50% rally off the bottom. We've recently had inscriptions and ordinals come onto the scene for Bitcoin. So what we're going to do is look at how the investor behavior has changed. What is the overall behavior pattern shift now that we've had something that is a fairly substantial rally year to date? So we're going to look at this from two different angles. The first thing we're going to touch on is a bit of a view on inscriptions and some of the impact that that's had. Now, you will find in the description below a link to a very, very detailed report that we did. That was back when we were in the process of crossing 100,000 inscriptions. We are now up to 150,000 inscriptions as of the time of recording. I think it's even more than that now. So I do recommend checking that report out. We went into a lot of depth understanding which types of inscriptions, how much data is it taking up, what are all those footprints. We will touch on some of the key elements here, but I would recommend checking out that report if you're curious about what ordinals and inscriptions actually are. We did do a detailed write-up on that. So that's the first angle we're going to look at, and the second one we're going to look at is breaking down the coin supply into our long and our short-term holder cohorts. Now, the vast majority of metrics that we look at today are going to be ready for advanced users. You'll see all of these supply metrics and various transaction volume metrics are available for our advanced members. And in the last chart, I'm going to give you a very, very quick snapshot for our professionals. We recently rolled out about 47 brand new metrics, which combine the goods. I mean, these are kind of my favorite tools: cohort analysis, long-term, short-term, realized profit and loss, capital flows and sentiment, and combining it with exchanges. So looking at long-term holder, transfer volume in profit to exchanges. Really, really cool stuff. Give you a very, very quick snapshot of what we've got in store for you there. But really, they're the kind of two angles we're going to look at it from: the inscription side of things, and we're also going to look at it from this long-term, short-term overall behavior patterns. As always, before we jump in, please do give us a rate, a share, and a subscribe. It does help this get to more people. We are going dark mode and full screen, so let's get right into it. Okay, so here we are. We can just look at a standard price chart, but where's the fun in that? What we're actually going to look at here is look at a bit of a workbench construction, just to show some kind of tools that I use on a regular basis, just to make it a little bit more exciting. So the main point here from a price perspective is that we are clearly butting our head up against the top end of this range that we've been in since June. So over the last 8.4 months, and I can tell you it's 8.4 months because that's what this curve here is calculating, we have essentially been underneath our current price. So we are basically pushing up to an 8.4 month high as we speak. And this has essentially erased the FTX event, which we saw in January, and we've essentially come up and recuperated much of the losses that we saw through the last 8 months. So I've got here a couple of formulas. The first one is using the value at, which is going to return this blue curve. This will point to the current value. You can also put a timestamp in here if you want to look at on the 5th of May 2010. You can also look at what the price was at that point. What I've then calculated is the number of months below. So doing a quick if-then statement: if price is below 1, if no, 0, and therefore doing a cumulative sum of that over the last little period of time. Dividing it by 30, that will give it to us in months. So we can see here that you can essentially plot out how many days price has been below where we currently are. Just a neat little trick, but it kind of shows you some of the things that, you know, I'll regularly jump into Workbench and use it to calculate things like this. You could do this for supply, you could do it for drawdowns. There's all manner of tools available for you. Right. So the other thing that's quite interesting with this inscriptions, so what we've basically seen is that inscriptions is kind of a way to embed arbitrary data into the Bitcoin network. Now, this has got some people not so pleased and many people extremely pleased. When we're kind of looking at the mechanics of what's actually going on here, people are essentially inscribing data into the witness portion of the transaction. We will touch on that in a second when we talk about mean block size. So just hold that thought for now. Now, an important note about inscriptions is that they do not require a large amount of BTC volume. Most people are using around 10,000 sats, and inscribing whatever that is, whether it's an image file, whether it's a JPEG, whether it's a movie file or a music audio file or text, inscribing that to a specific Satoshi that sits within that 10,000 sat volume. So what we're seeing is that the number of UTXOs, the number of actual UTXOs in the Bitcoin set, actually pushed to a new all-time high of 137 million this week. Now it's pulled back slightly from the peak, but you can see that this is actually the largest monthly peak that we've seen since just after the all-time high, and really back into bull market season back here in 2021, since we had this much UTXO creation. Now you can also see these periods here of UTXO destruction. This was actually during the low fee environment that we saw following FTX. A number of exchanges actually went about consolidating many customer wallets. There's obviously a lot of exchange activity going on, so they had to consolidate lots of wallets, and that actually reduced the overall UTXO size. So kind of interesting that we're looking at this. Has not got anything to do with transaction volume. This is literally looking at how many UTXOs exist within the set, and inscriptions push us to a new all-time high of 137 million. Now, one of the other interesting things that's happened as a result of inscriptions, they are using the Taproot script type. Now, Taproot, generally speaking, these, whether it's SegWit or Taproot, these things take many years. They're a very, very slow adoption process. Wallets have to be changed, people have to migrate over, people have to move cold storage coins, other people are testing them, applications need to be built that actually make people want to use it. So really, in many ways, inscriptions was the first time that we saw a real use case emerge for Taproot. There's going to be more down the line, but it was the first one that came onto the scene. And we can see the parabolic growth. At the peak, it was about adoption was 17.6% of all spending behavior was going on using Taproot. We have two different models here, adoption and utilization. We do have a paper that's associated with this, can help you understand the difference between those two. But clearly you can see the explosion of inscriptions and ordinals onto the scene. In terms of overall spent output, so these are the UTXOs that are being spent and destroyed. 8.12% of all of those outputs at the peak was Taproot. But what you can also see is a very, very significant cooling down. Once we cross that 100,000 inscription threshold, the kind of initial wave certainly started to pass. So we're down here about 2.8% of all outputs using Taproot. So we are still very early in this. We have to see whether these inscriptions really do catch on. Do they start to develop marketplaces? And do we start seeing trade volume associated with them? So very, very early. We've seen the initial 100,000 wave burst. We're now at about 150, 160,000 inscriptions. We will see how this plays out over time. Now, just a little bit of a history lesson. I mentioned the block size before, and again, I would recommend you go and check out our inscriptions and ordinals research piece for more details on this. But I want to give you a quick snapshot of how the data works, because a lot of people talking about, oh, this is going to create bloat in the chain and various data assumptions, and there's a lot to discuss here. But I want to just take this only looking at block size, only looking at how much has inscriptions changed the overall average block size. So the chart that we have here in orange is the average block size in bytes. So you can see on the right-hand side here, 1.6 megabytes, 2.4 megabytes. And then we have a moving average here in pink just to kind of clean that up. Now, prior to SegWit, which activated back here in 2017, this blue curve here was the 1 megabyte limit. And you can see that we came up and we butt our head against it for a period of time. Now, following SegWit getting implemented, we were able to actually break above that 1 megabyte limit. You can see that on average, we typically held a value of about 1.5 to up to about 1.8 megabytes per block on average. Now, the reason why is that SegWit split Bitcoin transaction data into two. There's the transaction data, the addresses, the who is sending, the how many coins, the UTXOs, the inputs, the outputs, all the transaction data. And then there's the witness data, which is the cryptographic signature to actually prove that those coins work. And nodes are allowed to discard the witness data and prune it in a different way. Now, very, very simply, the more data is in the witness side, the closer a block can get to 4 megabytes. When we're looking at purely transaction data, there can only be 1 megabyte. So what we're basically seeing is that there is this kind of balance as there's more signature and witness data, which inscriptions are essentially putting these images or these audio files inside that witness portion, it can push us closer up towards that 4 megabyte. So as I mentioned before, typically about 1.5 to 1.3 megabytes was a typical average block size. You can see in the orange here that inscriptions have pushed us up to between 2 and 2.5. It's only been about 2 or 3 weeks, but in that range, somewhere about 2 to 2.5. So it's increased the average block size by about 1 megabyte. There's been a handful of blocks that were actually individually 4 megabytes, but overall what we're seeing here is that we've seen an uplift of about 1 megabyte, and in our ordinals paper we do actually study what would happen in terms of blockchain size. Let's project Bitcoin out another 14, 15 years. I think it puts us in 2037. And to have a hard drive that can hold that future Bitcoin blockchain, assuming all 4 megabyte blocks, which is kind of the worst case and quite frankly impossible scenario, from here until 2037, it would still cost you $120 only to get a hard drive to store that. And that assumes that there's going to be no deflation in terms of overall technology prices. Now remember that hard drive storage space is only one portion of it. We also have to think about node sync times and validation times. But there's lots of talk, but overall in terms of the data footprint, basically the Bitcoin system was set up for SegWit to deal with 4 megabyte blocks. That was essentially the deal back in 2017. And it's really those other things, initial block syncs and other things that we pay more attention to. But anyway, it just gives you a bit of a snapshot as to some of the changes that's happened to the Bitcoin blockchain as a result of inscriptions. And you can see how dramatic this actually is, quite a significant push higher. Okay, so that's enough about the inscription side of things. That's kind of in the on-chain activity element. I mentioned at the start that inscriptions do not require a great deal of transaction volume. They're essentially moving around, 10,000 sats or thereabouts. Now, quite interestingly, it's lifted the on-chain activity space. We've seen active addresses uptick, we've seen transaction counts uptick, UTXOs hit an all-time high, but we have not seen a large amount of transfer volume. So this chart here, which you will also find in the supply section of our presets. This one here is in Workbench. We're looking at our supply presets. We're looking at young coin volume. So these are the volume of coins moved on a single day that were younger than 6 months. Now, bear in mind, if the same coin is spent multiple times, this will be counted every time it was spent. So it's looking at the raw transfer volume only for coins younger than 6 months. Now, these periods where we have very, very low transfer volume, you can see that we had one back here in 2014. We had one right before the sell-off event here in 2018, so a very low volatility environment. We had one in the middle of 2019 as we kind of sold off in that May, June, July period back in 2021, and now, and we're actually much lower than all of those previous instances. So even though we're seeing activity coming back in, there's not a great deal of coin volume that's on the move, which is kind of intriguing. As a result, this one here is looking at the total supply that was moved in the last 6 months. We call this the young supply, short-term holder supply. I've also put a value at formula here so we can actually track where this is and actually draw this horizontal curve. And you can see that very, very few instances. Remember, this is a binary system. Coins are either young or old. They're either short-term or long-term holder. What we're looking at here is because we're not getting a lot of transfer volume and young supply is not lifting higher, that means that those coins that are being spent down in that young supply are essentially coins that were already younger than 6 months. Because the only way for young supply to rise is when old coins get sold or spent, because what we're seeing there is that old coins have to become young in order to increase the young supply. There's always coins migrating and maturing over that boundary into the old supply realm, but also there's some coins being spent. When that's in equilibrium, there'll be no change. If you get lots of old coins being spent, you will see an uptick in this young supply. And when does that happen? Typically during bull markets near the top, because you've got lots of old hands spending, selling, exiting their position near the top, and you've got a whole bunch of new buyers. These peaks here are new buyers, inexperienced Bitcoin holders saturating the supply. Where we are at the moment is pretty much the exact opposite. We are not seeing old hands really liquidating at any significant state. But we can actually confirm this by jumping across to look at the old supply. So we've got two traces here. In the blue is all of the coins that are older than 6 months, and in the red is all the coins older than 1 year. Now, older than 6 months is currently in the process of pushing up to a new all-time high. It's not quite there yet, but it's very, very close, about 15 million BTC. And the coins older than 1 year is now over 12.1 million BTC. So actually, no, I think it's 12.9 million BTC. So have a look, 12.9. And that is at an all-time high. So we can look at that young supply and say, well, it looks like old hands are not really spending. We can look at the old supply and actually confirm that and say, yes, they're actually not spending. And we're actually seeing most of their supply curves hitting an all-time high. So even though we've had a 50% rally, we still are not seeing those old hands ready to distribute just yet. Kind of shows how savage the bear has been, that people are willing to sit tight and say, not today. And the last thing we can look at is actually confirm this by looking at the old coin spent volume. Now, in this one here, I've actually applied a if-then. I've used our value at function as well, and I've applied an if statement to basically model out and put these orange lines down to look at when we've had old coins being spent at this low of a level. You can see that on a 7-day moving average, we are at a very, very low level in terms of overall 5,300 BTC per day, which, you know, typically during these bull markets, we're talking about 30, 40, 50,000, so 10x more in terms of overall coin volume being spent. And you can see that these orange bars typically show up at very, very low volatility. So at the bottom of these corrections, kind of before something changes. You can see here back in 2019, we had a rally which then sold off again. Here we had a rally that pushed us up to a new all-time high. This was just prior to FTX. We had very, very low volume. And here we are again with an extraordinarily low amount of volume. Typically speaking, what we're looking at here is that old hands slow their spending. And we can try and look into this from many layers. But in terms of a very, very high level snapshot, when old hands stop spending, it's because their behavior pattern is starting to change. They're either seeing that in a bear market, for example, prices come down so low and they're like, well, I think it's probably going to rally from here, so I'm going to stop spending. Or it could be that they've just hit the point of seller exhaustion, where those old hands, there's just no one left who actually wants to spend their coins at that price. Same thing can be said back here in July 2021. So typically speaking, it shows when you get this real decline, a major decline, you're seeing a change in investor behavior. Now, the nice thing is that we can supplement this by looking at both their average cost basis. So this is looking at the, and again, this model here is also available for advanced users. You'll find it in Workbench under our pricing model presets. This is our old supply, realized price in blue, young supply in red, and the all market in orange. And what we can see at the moment is that we have, very similar to 2019, we have poked our head above the long-term holder or the old supply realized price at 23,400. So we are currently sitting above that, and that means that all cohorts on average are now back in profit. And you can see that we also have the short-term holder cost basis starting to climb. I'm going to zoom in on the last 3 years so we can see our current cycle. And you can see that we have the short-term holder cost basis starting to climb and pushing up above the realized price. So we're getting that momentum starting to kick back in. And again, it's starting to signal that there could be a bit of a change in investor behavior that is underway, particularly now that all these investors are now back into a profit on average. Now, one of my favorite models, once we've kind of established all of this, we've seen that old hands are spending less, we've seen that young hands are also spending less, it's kind of a bit of a decision point. There's something that looks like it's a bit of a regime shift could be underway. Now, a SOPA and any kind of SOPA variant, these are some of my favorite metrics to look at for this moments like this, because they're fantastic at helping us look at investor behavior and when we get these big changes. Now, for any of you who've been watching this channel for some time, whenever I'm looking at something on a bigger picture, I like to put on like a 7-day, I like the exponential moving average for SOPA variance, mainly because it's faster. It gives me a little bit more weight towards recent days, but it's also going to clean out all that daily noise. The simple moving average, sometimes you don't quite get as sharp spikes when you're looking at a metric like this. Now, SOPA is a profit multiple on coins that are spent. And for the A-SOPA variant, we're looking at the entire market. So we're just looking at a full cross-section. Now, something that you'll probably notice is that during bull markets, we typically bounce and find support on a value of 1. This is essentially indicating that those people who bought the top are now starting to flush out their coins. They're selling to overwhelm all the profitable coins. Those who have massive profits, because any kind of profit's going to put upwards pressure on this metric. So at the bottom of these corrections, right, at the same points in time when we see that those old hands really slow their spending, what you're seeing is that they are slowing their spending and they're no longer selling because they've seen the correction. They feel like the correction has kind of done its thing. In bull markets, a retest of 1 on SOPA generally indicates a bit of a buy the dip type mentality. It's people who have prices come back to their cost basis. People are no longer selling at a profit. The people who bought the top are essentially flushing out their coins. A nice little undercut means that those who literally bought the top are now getting flushed out. And then a strong bounce from there is a good sign. The exact opposite is true during a bear market. You can see right before FTX, we saw people come up and give me my money back. I'm selling at my cost basis. I want the exit liquidity. And we got the sell-off that followed. And there were several of these events over the course of 2022. So zooming in on our recent history, we have finally got a significant break above. We found support once, twice, and we're starting to, what we really want to see is this metric push higher. That would signify that the market is absorbing profits. There's enough demand to take that absorbed profit, and we do have a bit more positive momentum. So we've got these first initial retests. It is possible that we are on the cusp of a bit of a regime shift. We're seeing investor behavior changing. We're not seeing old hands coming back into the fore and spending their coins. We're still seeing that there's profits being locked in and the market seems to be holding it. So there's a couple of things here signifying that we could be on the cusp of a bit of a regime shift. So the last metric that we're going to touch on is one for our professional members, giving you a bit of a snapshot of a suite of 47 metrics that we released last week. And they're trying to combine 3 core components that we use here in on-chain analysis. One is cohorts, long and short term. The other one is our exchange data, which is trying to map out what is the most accurate sell side pressure that we're seeing from these different cohorts. And then also combining it with our realized profit and loss, which we find is excellent for looking at capital flows, sentiment, capitulation, profit, short-term, long-term in terms of market cycles. So really looking at kind of the micro and the macro, but combining cohorts, exchanges, and realized profit and loss. So on the left-hand side, you'll find all of these under our long-term, short-term category. We've got coin day destruction and dormancy, bringing that lifespan in for these different cohorts. We've got volume in profit and loss of these cohorts to exchanges. We've also got realized profit and realized loss, as well as realized profit and realized loss to exchanges. So this particular model that we're looking at is relative. So looking at it of all of the realized value in that particular day, how much of it was long-term holders, short-term holders, in profit and in loss. So a couple of interesting dynamics here when we're looking at the relative amount of realized loss by long-term holders. It's kind of interesting that this particular cohort tends to have their absolute peak very close to or near the bottom as cycles start to change. What we're basically seeing here is that these long-term holders are those who are essentially top buyers. They are folks from the previous cycle. They've done their 155 days. They've passed the gauntlet of time. But when they actually start expelling their coins in a loss, they're essentially doing it at the exact wrong time. It's one of these market anecdotes that you see play out over and over again. People will typically take that first exit liquidity rush, get out of their position, dominate what you're seeing in terms of long-term holder flushing out in loss. And it's kind of interesting that this tends to peak and very, very quickly decay as that investor behavior starts to change. And we can see here that we've had that peak over 57 or 58% of all losses being locked in by long-term holders on the 5th of January, and that has since declined to around 34%. So a fairly substantial decline. We've basically seen that purging of the previous cycle top buyers. When we look at our short-term holder cohort, we actually see a very, very interesting dynamic. As we come in towards late stage bear markets, you'll see that these peaks start to decline. You get this decaying off. You'll always get these capitulation style events where the losses start to dominate. But generally speaking, you'll see this decaying off, and eventually on that relief rally, as we had here in 2019, short-term holders explode back into profit. This is really describing that over time, people, short-term holders are buying, they're selling, they're getting flushed out progressively as the bear market proceeds onwards, and eventually a floor gets established. And you can see here that we had a very, very similar decay in our short-term holders in loss all the way down to a particular low. What we then see is that because there's been such an enormous changing of hands, so many coins have now found a new owner with a much more favorable, much lower cost basis, particularly considering we looked at the beginning how this recent kind of bottom formation we've been in was somewhere on the order of about 8.4 months. So that's enough time for all of the short-term holders to be contained within that bottom formation range. So now that we've had a significant rally higher, essentially all short-term holders are by definition in profit. Aside from the guy who literally bought the top tick, almost every short-term holder right now is in profit. So you basically get this explosive changeover where you see that those short-term holders return to a profit. Pretty much all of those long-term holders have been flushed out, and you can start to see these cycle resets. And obviously this works in both directions as well. During bull market peaks, you essentially have the largest number of short-term holders with coins near the top, and you see this rapid explosion of short-term holders in loss. Shows that massive decay of price, and a lot of people who are trapped above, or in our instance at the moment, trapped below, but trapped in a good way in terms of having a low cost basis. So please do let me know as you start to explore these new metrics. If you are looking through, please feel free to let me know if you have any comments or thoughts. This is something I'm actually currently experimenting with and exploring, so I'm as excited as I hope you are to really play around with these. I find realized profit and loss to be an exceptionally powerful technique, and particularly when we layer it in with exchanges in our cohorts, it really does give us something quite exciting to play with. So thanks everyone for tuning in. Hopefully you found that session useful. As I mentioned, pretty much everything with the exception of that last chart is available to our advanced members. You'll find many of these in our HOLLiiWOOD Dynamics dashboard. So do check that out. Please let me know if you have any other questions, and I look forward to seeing you in the next one. Cheers. Hello everyone, and welcome to another Glassnode market analysis video where we're going to be looking at a really interesting tool that we've just released that is designed to help identify extremes in the Bitcoin market. This is one of these holy grails that everybody's always looking for, the market tops and the market bottoms. And of course there are tools that you can look at individually or in combination to try and identify those. What this tool has really been designed to do is bring all of that confluence together, and it's quite similar to the confluence that we looked at in our previous product that was like this. You may have seen that was trying to recover from a Bitcoin bear, looking for when adoption is picking up and profitability is returning across different sectors of the Bitcoin market using on-chain data. So what we're doing here is bringing that same concept of confluence, multiple components of the Bitcoin market, and trying to bring them all together to identify where we are at an extreme level and a bit of a methodology behind that. So when we're looking at on-chain data, of course, what it's really doing is describing investor behavior. You hear me talking about this all the time, but even within that investor behavior, there's different categories that we typically look at. You'll hear me talk about on-chain activity, profit and loss, lifespan. There's a whole suite of powerful tools that we can use to really assess what is going on under the surface. So what this tool has been designed to do is really, as you can see in the orange, trying to find periods of time where the market is quite overheated. And we're seeing many of the behavior patterns showing up that typically describe a market cycle top. And likewise in the blue, we're looking for those investor behavior patterns where we've got all of the opposite events. Do we have those characteristics that really describe that more bearish, deep bear market sentiment? So what we're going to do is actually combine four very popular but largely underutilized models and a little bit of statistical tooling to just add that extra confidence to what we're doing, and then bring it together into a single Confluent product. So what we're looking at here is four different metrics, and you've probably heard of all of these before. And any of you who are using a Glassnode account, by the way, this entire thing is available for all of our Glassnode Advanced members. You can start a free trial if you want to test out this one, as well as the Recovering from a Bitcoin Bear dashboard, which is kind of showing two different elements. And these two dashboards actually speak to each other, because if we're seeing that we've got these market extremes, particularly the cycle low type behavior, then we can move on and look at the Recovering from a Bitcoin Bear. So we see, do we have the behaviors that we typically see at the bottom of a bear market? And then are we seeing that recovery back out the other side, adoption, growing, profitability, and the like? So the four tools that we look at is the MV/RV ratio, which we will touch on a little bit in more detail, because that's kind of the crux of it. And we actually have a series of dashboards to help explain that for both Bitcoin and Ethereum. We'll look at SOPR, Pure Multiple, and the reserve risk. And these four objects are trying to look at four completely different parts of the market. For MV/RV ratio, we're tracking the unrealized profit and loss. What are the paper gains or paper losses held by the space? SOPR is looking at the realized profit and loss. How much are people actually locking in with their spending patterns? The Pure Multiple is tracking miner revenues relative to their yearly baseline. And the reserve risk is a lifespan-based metric where it's capturing how many coin days are actually being accumulated by the market. So it's tracking that hodlers and the lifespan component. So when we put all these together, we're looking for confluence across unrealized profit and loss, realized profit and loss, miner revenues, and the coin day destruction, coin day creation type behavior with the hodlers and lifespan. So without further ado, let's get into it. Please do let me know in the comments if you enjoy this type of content. This is a new concept and a new idea and a way to kind of display and really distill all of the on-chain data that we have into tools that are just that little bit easier for people to grasp, a bit more of a visual tool. So as I mentioned, you will be able to access all of this with a Glassnode Advanced account, so please do check that out. And just before we get started, we are actually hosting a webinar for the MV/RV ratio. So we'll touch on that MV/RV dashboard to start, but a much, much deeper dive is coming in a webinar, which you'll also find in the link below. Right, let's get started. Okay, so as I mentioned, this is our Mastering the MV/RV ratio dashboard, which again, you will find this in the link below. There is a full report, and we will be diving into this in the webinar that is upcoming, but I just want to touch on this particular dashboard, which you'll find under Bitcoin, Profit and Loss, Mastering the MV/RV ratio. You will actually also find an equivalent version for Ethereum, so you can look at it across both of the two major assets. Now, the reason that I want to touch on this is it's a bit of a methodology which we're going to redeploy and use across all of those four oscillators that we just looked at. So I really want to touch on that particular concept. So what we look at here is for the MV/RV ratio, we can see that it cycles between tops and bottoms, as do all of the four metrics that we look at in this study. And you can see that down the bottom here, we can draw these horizontal lines and say, this is what it looks like at an extreme. But how do we know that those levels are going to stick around long term? As we can see, MV/RV peaks in particular are getting lower and lower over time. As volatility comes out of the market, Bitcoin gets larger, the future is also just uncertain. There's less confidence in what's going to happen long term. So drawing horizontal lines on a chart, it's okay, but it's not perfect. Now in this study, we do show you a methodology looking at how many days below or above that particular level. So for example, for this red curve here, if it's only spent 10% of all days higher than that level, then when you see MV/RV at that level, it's probably an unlikely scenario to stay there, because there's a 90% chance it wants to be lower than that. Likewise for the low levels, when you have very, very low levels and there's less than 15% of all trading days that have ever been below that level, if you believe in mean reversion, then you can expect that there's a higher probability that things want to go in the other direction. So that's the initial framework. We're looking at how many days above or below a certain level do we actually see this event taking place. Now, the challenge with just drawing a horizontal line is that the market may change. We just simply don't know what the future may hold. Bitcoin cycles may start to evolve, and it's a little bit variable, and quite frankly, it's arbitrary. We can try to make it a little bit superior by using percentages and the like, but we could also use statistics. So on this model here, the blue curve is the all-time moving average for MVRV. And as you can see, it typically sits pretty much smack bang in the middle of it. We can see that most deep bear markets trade substantially below it. Most raging bull markets trade substantially above it. It does sit in the middle. It's the all-time average. So for any of you who are familiar with statistics, you can then look at the standard deviation, which is basically a measure about how far away from that mean have we stretched on a statistical standpoint. So for this model, all we've done is add -1 standard deviation and +1 standard deviation. And you can see that this here is now a more mobile and fluid curve, but it's going to evolve and adapt as MVRV adapts. So as the market starts to evolve and over time, we have a bit more reliance that at the very least we're looking at a statistical deviation. We're looking at something that's a bit more robust than just a horizontal level, which in many ways it's kind of finger in the air, hoping that it stays the same. So now that we have this framework, we can actually start to identify levels where you have above that mean +1 standard deviation, and these blue zones where it's mean -1 standard deviation. We're looking for these extremes based on a statistical model rather than just kind of finger in the air horizontal lines. Now, as you can imagine, we can run this same analysis and this same study for several different metrics. It takes a little bit of work for some of them to make sure that they're in the right format and they truly are oscillators and also that they make sense. But that's really what we've tried to do with our newest dashboard that's just launched. So this thing here is trying to stitch together that same framework that we just looked at with MVRV. Let's apply that same concept to those 4 different sectors: MVRV, A-SOPA, pure multiple, and reserve risk. And let's see if we can then combine how many of those signals are actually telling us we're at an extreme to the upside or an extreme to the downside. So you will find this dashboard, as I mentioned, this is available for all of our advanced members, which you can start a free trial. You'll find a link in the description below. You will find this one underneath our signals and then under the Bitcoin on-chain. And here's our recovering from a Bitcoin bear that we covered back in January, which really is the dashboard that would follow one of these blue events, right? You see these large-scale capitulation events. We see investor behavior that looks like a bottom. And then we start to look at, do we actually see recovery and adoption out the other side? So you can start looking at these things in sequence. Now, what we're going to look at here, the way that this signal is constructed, it's what I'm going to call a binary signal. What I care about is MVRV above, meaning 1, or below, -1, those extreme deviation bands, ±1 standard deviation? What about A-SOPA? Is that +1 or -1? If it's not above, it's kind of in the middle and it's inside that kind of main deviation band, then it's just going to return 0. I don't care about what's happening there. We're looking for these large extensions to the upside and the downside. So that's what these colored bars are showing. It's showing us in the green is MVRV above an extreme or at -1, which means it's below an extreme. We can see that we've got our A-SOPA here, which is that realized profit and loss in yellow. Blue is then capturing our mining revenue, pure multiple, and reserve risk is that hodling behavior that's going on. And then the black trace that you can see over the top here is then taking the 7-day moving average, exponential moving average, of those 4 results. So basically we're looking at how many of the 4 signals are actually firing off at any one point in time. If all 4 of them are firing off for 7 days, then the signal will return a value of 1. And it will start to decay and move around as those different binary signals fire off. So if we actually look at this in the big picture, what we're going to do is just do a snapshot and then we'll go through each of those individual indicators. I want to give a bit more bones to this so you understand why we look at it from this perspective. But as you can see, it's really picking up the very, very overheated market tops. You can see that it picked up both of these 2013 peaks, and you can also see down near the lows. It is picking up periods in time where investor behavior, mining behavior, lots of these elements are showing us that we have similar behavior patterns that are outside that statistical deviation. So just to give a bit of confluence, right? So let's talk about what the actual investor behaviors are, because it's all well and good to look at an oscillator and say, oh, look, it's at a high level or a low level. But what does it mean? What does it actually tell us about investor behavior? And this is really where on-chain data, at least in my view, is quite special. It is showing us the behavior patterns of everyone who is transacting on chain. Or, in the instance of reserve risk, for example, not transacting on chain, same as MVRV, because coins that people still hold is telling us a signal. They are choosing to spend it, or they're choosing to not spend it. All of these decisions are what's showing up in this on-chain data. So let's think about a meteoric, euphoric bull. Every man and his dog is, seeing the market just go higher. What are the typical behaviors that we see at those all-time highs, at the most heated bull market segments? Well, the MVRV is telling us that the market holds significant unrealized profits. Everybody's got a very green portfolio. We're all sitting very happy saying, this is wonderful. I'm just going to sit here and let it go. But remember, there's a point in time when every investor sees enough green, they go, ooh, I like that price, to be honest. I mean, I like Bitcoin, but I also like that price. So at some point in time, getting to a level of unrealized profit becomes unsustainable because people just get too excited and eventually they sell. S.i.R is the result of that. Are coins that are being spent realizing large profits? The longer that someone's held and the earlier that they acquired these coins, if people are buying at the bottom of the previous bear, they've got guts. They are the people who stepped in at the bottom of the bear and believed in Bitcoin when nobody else did. If they're the ones selling, you're getting a view of the smarter money. You're either seeing when S.i.R is at a higher level, you're seeing that everybody who's spending is getting large, they're locking in large profits, or the people who are holding the largest profits are dominating the spending, which is typically the smart money. The pure multiple. This is modeling miner revenue relative to the previous year. Miners are the production side, and if you think about mining 900 BTC at a current price of 23,000, well, imagine if price went to $1 million. It's still 900 coins. But the amount of capital that's required to absorb those 900 coins is substantially larger at higher prices. And especially if the market has run very quickly, the incentive for miners to actually distribute those coins and, take that money and pay back shareholders and reinvest, all of those things start to kick up. And conversely, with reserve risk, and all of this is said and done, the amount of hodling that's going on is reaching an all-time low. Reserve risk is an inverse indicator, meaning it will trend higher when there's very little hodling, and it will trend much lower when hodling is dominating. So at the market peak, everybody's holding significant unrealized profits. The people who have the largest profits are actually starting to sell, which also means that those hodlers, who are typically the ones with those large profits, the smart money is starting to distribute. They're seeing that Bitcoin is expensive, and miners, the cost of their production is currently extraordinarily profitable, especially relative to the last year. All of these things at the top create confluence of distribution. They create a sense of coins being flushed back out into the market. Now, what's happening at the bottom of a bear, at the absolute pits of a bear market? Well, it's the exact opposite. People are holding significant unrealized losses, and the only people who are going to weather through that pain and see that red and still not spend are the people who are going to be reflected in the reserve risk, where they are essentially holding this thing. They are acquiring these coins despite all the bad headlines and despite the red candles. Those people who are spending are the ones who literally bought the top. This is what capitulations are. They are a flush out of entities. And the last one is at the pure multiple. What we just went through is we saw that miners, the hash ribbons start to invert, miners start to capitulate, and they're typically selling coins at the extremes, either very, very profitable bulls or typically in distress at the bottom of bears into an already damaged and vulnerable market. So that's really what these four indicators are trying to model, or they do model individually, but the goal here is to stitch them all together. Now, down here you'll find the individual signals, right? So for MVRV, you will see points in time when it itself is breaking above that band, and you can see that S.i.R, for example, that realized component is much, much sharper. MVRV spends a little bit of time up here during tops. S.i.R is much more reactive and more responsive, so it helps to really refine the model and bring it down to some more narrow elements, whilst also giving us the unrealized, the realized, the mining across all these different sectors. We can see the pure multiple sits somewhere in between MVRV and S.i.R in terms of its responsiveness. And then the reserve risk, sorry, this one here we've actually done it as a reserve risk multiple, which means we've divided reserve risk by its yearly average, which brings it into a nice horizontal oscillator. Some of these we will put a bit of a transformation on just to kind of neaten up the data and make sure that the statistical models are actually going to work over the long period of time and smooth out some of that noise. But for all of these, we've essentially set up very, very similar deviation bands and then use those to try and identify when the market is in or out of bounds. So when we distill all of that down together, what we're basically looking for is, out of those 4 metrics, how many of them are actually firing off at any one point in time. We've smoothed it over with a 7-day moving average, which gives us that kind of more of a signal type behavior. It's not immediate. So for example, to end up in these topping zones, what we're looking for is that it has to have all 4 metrics firing off over a couple of days. It's not an immediate thing. We're looking for that smoothing out the daily noise, and these numbers can all be kind of adjusted and refined. If you are actually interested, you'll be able to jump into the workbench itself and actually make a copy, and you can play around with some of the parameters if you choose. But really the goal is to try and find when are all of those 4 signals telling us a similar characteristic. What is that telling us about investor behavior? When are we seeing that start to tick in at the upside and the downside, and overlaying it with a level of statistics to give us that extra confidence that there really is something going on here and it is out of bounds. Now remember that the market is always going to be variable, even when we do combine these things into confluence and indicators that are telling us a similar story. Absolutely anything can happen. So you have to remember that these things are never going to predict the future, and there never will be an indicator that can. What we're trying to do here is look at the investor behavior, the actual behavior patterns that we typically see at these extremes, bringing them together and saying, do we have confluence across all of these things which have described these patterns in the past? And then we are essentially applying that to what we're looking at the moment. So as always, if you do have any questions on this, please do reach me in the comments. Let me know if you enjoy this particular type of these types of models, because it does help our team really build out these things to help people understand what's going on within the world that is quite confusing as it is. So thank you for tuning in for that session. Hopefully you found it useful. All of the dashboards, both the MV, RV, and this one, you will find available for advanced members, and you can start a free trial. There'll be a link in the description below. Please do let me know if you have any comments or questions, if you enjoy looking at and using tools like this that kind of bring the on-chain smarts together and try and distill it down to a tool that's a little bit more approachable than the individual metrics themselves. Please do let me know if you enjoy this type of content, and I look forward to seeing you in the next video. See you then. Cheers. Hello everyone, and welcome to your Glassnode video report for week 10 2023. So we have seen a bit of a pullback of late, and what we're going to look at today is some of those key levels, and there's about 3 of these on-chain cost bases that are relevant that we're going to explore today. And what you'll often find, or certainly I found in my experience, quite often when you look at these realized price levels, they often tend to coincide with technical analysis levels. And the reason is really it's the same thing. They are coming from investor behavior. Price action is a result of human beings making collective decisions on buying and selling, as are transactions moving around on chain. So what we tend to see is that these things often coalesce around similar levels. There's the 200-week moving average, which a lot of people have been looking at. We've been testing the underside of that, and that just so happens to coincide with 3 fairly significant cost basis levels. So we're going to explore that in a bit of detail, and just kind of get a bit of a gauge on how you consider these realized prices in particular. So not only are we going to be looking at these realized price levels, we're also going to be looking at 3 concepts really. The first one is there's some popular metrics, net unrealized profit and loss, or NUPL, and MVRV. These are 2 very, very popular oscillators. They're both actually derived from each other. But the challenge with these is that they're measuring the amount of unrealized profit and loss in the system. But there's coins that are lost. Satoshi's coins, early miners, coins that just have never been spent from back in 2011. Do we really care that they're in profit? We know that they're in profit, and really until they're spent, we kind of assume that they're lost. So I want to take you through a bit of an exercise that we're going to do to actually eliminate and remove those coins to get a more accurate view on the reality of where the cost basis of the market is. We're also going to look at some momentum and some of these different metrics, these volume momentum type tools in the on-chain activity space to look at kind of the adoption and the growth. And we're also going to look at profits being taken as we impulse higher and we actually see that momentum kick in the space. And that's the thing, when you start to see these transitional periods, if we are starting to come out the back end of a bear, something that you want to see is profit taking and the market's ability to absorb that. That's a regime shift. And over the last couple of weeks, we've kind of been in this, are we not in a transitional period? So a couple of metrics to try and track that. Now, if you did miss it, yesterday we released a brand new dashboard which is designed to help people find overheated and underheated conditions, really trying to use some very popular oscillators, MV-RV ratio, pure multiples, SOPR, and reserve risk to try and find confluence around market tops and bottoms. You'll find a link to the description, to the video and to the dashboard in the description below. And please, as always, do give us a rate, a share, and a subscribe. It does help this channel. Right, let's get stuck into it and get into the analysis. Okay, so we are going to start with the concept of cost bases. Now, the idea here is what we're looking for is the average price at which every coin moved, often called the realized price. Now, that's all well and good, but we can also, because we have the power of on-chain analytics and we can inspect different cohorts, and this is really where on-chain analysis starts to diverge from traditional finance, aside from being a whole lot more fun. We can actually break down the market into whatever cohorts we happen to want to look at. Now, in this instance, we've got this blue curve here. This is our older supply, coins older than 6 months. So if you can cast your mind back 6 months ago, we had the 3 arrows and the lunar collapse. We were in this consolidation range. As we documented through those weeks, there was a huge amount of accumulation and capitulation that went on. And then we had FTX, which just kind of amplified that whole thing, and we saw more of the same. So 6 months plus ago, we're in the bottom of this consolidation range. We've kind of just entered it. We're about halfway through, actually. But the other side of it is there's a lot of people from the previous cycle. So this blue curve is picking up a huge amount of supply that's held in the previous cycle. People who are still today underwater on their coins. So as you can see, we found resistance once, we poked our head above twice, and we found resistance on the other side and have since broken below. So again, this often aligns with technical analysis indicators. We also have the 200 week that is sitting at this similar level. But you can see that basically we're getting up against resistance of people who are essentially, on average, underwater because they were top buyers from the previous cycle. There's going to be plenty of hodlers who are just not going to care, but there's going to be some that as price comes back and they've kind of sat on their coins underwater for a year and a half, 2 years, and then finally price comes back to their break-even level, some of those folks are going to create resistance by actually wanting to exit. So it really shouldn't be too much of a surprise that we find some kind of resistance here. But of course, that is not the only level that is sitting at this place. This here, we're looking at whales and exchanges. So whales being entities with more than 1,000 BTC in their wallet. This is using our clustering algorithm. So it's trying to actually look at which whales. We're not just looking at a single address with 1,000 plus. We're trying to look at all their different behavior patterns for those different entities. Now, for these ones here, I've got 3 curves. The yellow one here starts at the start of Binance, because really, the chart that you can see on the screen, this zone of price action really is kind of the mature market. If you go back before this, and even, before Binance, that's kind of a nice threshold, somewhere in the middle of 2017, where the market is now large enough, liquid enough, big enough for whales to actually participate in any kind of meaningful scale. If you go back to 2015, it was actually much easier to become a whale. If you go back to 2011, it was much easier to become a whale because coins were cheap, coins were easy to mine. The market dynamics were just very different, and it didn't really even have solid exchange infrastructure for trading. So the 3 curves I've got here, the first one is kind of starting at, let's call it our modern history, when Binance started. Again, these dates are a bit arbitrary. We're just picking something that's meaningful. We've started our second one here, the purple one, which is the most important one, at the bottom, the absolute bottom tick of the 2018 bear market, and we started another one in 2020, at the bottom of March 2020. And the reason we've chosen these, this is literally, if you look at the average acquisition price for whales, it cannot be more opportune than this. This is literally looking at whales who started accumulating at the very, very bottom of the previous bear cycles. And what you can see is that we actually came up and retested pretty much the exact same level as our older supply. We have been testing the realized price of the 2018 bottom whale cohort. You can see they've been in the money through all of 2019. They had a brief scare here in March 2020, but price has been essentially above their realized price until the deleveraging event back here in June, and it has essentially found that first point of resistance, and here we are finding the second point of resistance. So again, a single realized price, well, who kind of cares? But when you have multiple realized prices telling you the same story and the 200 week, you start saying, okay, there's not only, 200 week is something everybody is looking at, it's fairly widely observed. You've also got a psychological element to this. There's entities in this market who are actually kind of sensitive about this particular level. Now, probably the more interesting and exciting one, this is going to blend what we're talking about with MVRV and Nupal. So we mentioned before, I don't particularly care that Satoshi's in a lot of profit. We know that that's true. But does it really matter that he's in tens of thousands or millions of percent profit? Yeah, probably not. It doesn't really matter. Until he really spends those coins, they're kind of dead. So what we're doing here, there's two metrics we're going to look at here, adjusted MVRV and adjusted Nupal. And you will find both of these inside Workbench under our profit and loss category. You'll find adjusted MVRV and adjusted Nupal. I've been spending a bit of time, and me and my team have been looking into this and trying to understand how do we discount the tremendous profits that are held by Satoshi & Co. Now, why does this matter? Well, if you think about it, let's imagine that Satoshi's coins are truly lost. The losses that we've seen from the 2022 cycle are essentially being offset by the tremendous profits held by those lost coins. So in a way, when we're looking at standard Nupal or standard MVRV, we actually are looking at a kind of quieter picture. The damage is actually much, much worse because all those losses by investors that bought up in the top of this market are being offset by the profits held by Satoshi. So if we remove the profits held by Satoshi, what is the true representation of where the average cost base is? The real realized price, well, an interpretation of the realized price, where is that if we discount all those very, 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 very profitable coins? Well, the blue curve is our standard MVRV and the orange is our adjusted MVRV. And the adjustment here is simply subtracting any coin that's older than 7 years. We don't care about the profit held by coins older than 7 years. The nice thing about this metric is, let's say a 7-year-old coin gets spent, this metric will automatically adjust because it will realize a profit, it will come back into circulation, and this metric will automatically recorrect itself based on that event. So with that said, you can actually see here that the orange curve in 2017 starts to diverge. MVRV is trading lower than the standard MVRV. We'll talk about this in a second. The concept here is because there's less profit in the, let's call it the active supply, the supply that's really moving and inside the system. There's less profit in there, which means that the average price, the average acquisition price is actually higher. And it makes sense because people are buying at 50, 60,000. We don't care about the prices at $0. We care about 50, 60,000. You can see that we are actually testing the underside of the adjusted realized price, 24,700. Now, that particular level, we often talk about the realized price as the average acquisition price of the market, and that's true, but only if we consider Satoshi and all those lost coins as active participants. If we choose to exclude those as active participants, then a more accurate representation, assuming that 7-year-old coins, that's a simple heuristic, that's the assumption, but if we assume that 7-year-old coins are lost, that's our assumption, then we are actually retesting the real realized price. The actual cost basis of the market is higher. And that means that the MVRV, which is the profit multiple, the unrealized profit multiple, is actually lower. So with this particular model, we can start to assess of all the active supply, where is the realized price? And we can see that we're currently testing the underside of it. Now, in a very similar frame of reference, Nupal, which is another metric, you may have noticed in the standard Nupal that the bottoms tend to be on this ascent. They tend to be climbing each cycle. They're drifting higher. That is the result of these lost coins holding larger and larger and larger profits, despite the fact that they're really not economically meaningful. So if we subtract those out, our orange curve here is showing us the true damage of the 2022 market. And you can see that we've actually dipped down to the same level as we were in 2018. If we compare these, apparently the 2022 cycle was not as bad as 2018, but that's actually not true. It was as bad, if not worse, and equivalent to what it was back here in 2015. So by actually removing this long-term supply that just hasn't moved in 7 years, and see these zones where it goes down, this thing here is this metric actually self-correcting. When those coins are in fact found, oh, they're not actually lost, someone spent them. This metric will automatically correct itself. So it's just one of these approaches we're using to try and better understand the true nature of these markets, where the real cost basis is, and where the real unrealized profit and loss really sits. So moving on to our second topic, looking at on-chain activity, you'll notice that we've been using these momentum charts, which is basically plotting the monthly moving average in red versus the yearly in blue. It's a really nice way. It works quite well for many on-chain activity metrics, because what we're trying to track is the near term, the monthly, the recent activity, picking up relative to the long-term baseline. And if it's above, it is. If it's below, it isn't. But I want to introduce another concept here about, I'm just going to call it payload. So we're looking here at new address momentum, so the number of new addresses. This does not account for if the address holds a whale amount of BTC or it's creating an inscription and an ordinal with 10,000 sats. So it doesn't account for coin volume. This is purely an activity-based metric, more akin to the user base, less akin to the wealth distribution. So with that as context, we can see that we have a very, very nice push higher. In terms of the overall monthly activity, we now have a strong leg higher. It actually resembles 2019. It's got these kind of waves that are pushing higher, and the yearly is also starting to curl around. So in terms of the user base and the activity side, we've got some positive momentum. This is good to see. But does that actually carry any transfer volume? Do we have a payload that's actually associated with those addresses, or is a large majority of that actually associated with ordinals and inscriptions? Now, there's no question that seeing more people coming into Bitcoin, even if they're transferring 10,000 sats, and even if they're transferring ordinals for JPEGs, that's still adoption. So it's still an important and meaningful perspective here. When we're looking at transfer volume, however, this is a bit more onto the economical frame of reference. Are we actually seeing value flowing through the chain? Now, by this metric, there's a few things to note here. We're looking at the transfer volume, so the amount of BTC that's on the move. Note this enormous and precipitous decline. Now, it is worth noting that this bubble that you see here, pretty much from the all-time high to right before FTX blew up, this large bubble is heavily to do with FTX and Alameda misbehaving, really moving around people's funds, misbehaving and misappropriating funds. So there was a huge amount of transfer volume that was associated with that entity, unfortunately. So this thing here is basically coming off an artificial peak, right? So we are in the process of recovering from that, but you can see that this is actually quite low down. So if we were just to look at this particular metric, we're basically looking at all the activity on the chain, but it's going to be a little bit clouded by some of that misbehavior that was going on, unfortunately, in the really in the last 12 months. But we do have a solution to this. This here, we're looking at the exchange volume momentum. Now, the nice thing about exchange volume momentum, and you can see here that we are missing that bubble. Basically, once the all-time high got put in, we moved into a nice and consistent structural downtrend. This is much cleaner. The reason why this metric is very, very good to look at, and again, you'll find this in our exchanges and the other ones in our economic indicators, you'll find these momentums. This is benefiting from all of our clustering for wallets. So we are looking at the exchanges and we have a very, very good view of coins flowing in and out of Binance, in and out of Coinbase. So this here is really going to filter for the coins that are going in and out of exchanges and are really generating that price action. If you've got a bunch of washing going on-chain, coins moving between Alameda and various other entities, that's kind of not really economically meaningful. We also see this cleanliness in our entity adjusted variance. It's just kind of those more raw transfer volumes where you'll lose that signal. But we can correct for that by looking specifically at our exchange volume because it's much, much cleaner data. And what you can see, we similarly have a bit of an uptick, but we are still down below our yearly baseline. So the real takeaway here, we do have more on-chain activity from a user base perspective, but we don't yet have it coming in from a transfer volume, a payload, a value moved perspective. So it's just something to be aware of. We don't necessarily have volume moving, and to be fair, That's not the worst thing, because volume moving also means that people who acquired at cheaper prices, like over the last couple of months, are essentially exiting their position at scale. So it's kind of a bit of a both. We're in this transitional period where we're still very much in a hodler type territory, even though there is a little bit of momentum picking up. So either way, some things to pay attention to. Now, the last topic I want to touch on is that profit-taking concept. And what we've got here is two metrics that I use all the time. Variance of SOPR, spent output profit ratio. This is a profit multiple. Look at all the coins that were spent on each day. What is the average profit above one, or loss below one that was locked in by the market? So as you can see, after an extended period, really since May 2022, we traded well and truly below a value of one. This is the market, on average, locking in losses for many, many months. This is pain, and you can see the scale of the FTX capitulation, one of the lowest readings that we've ever had. By the way, I have this on a 14-day moving average just to smooth things out, get rid of that daily noise, and we're really looking at the structural trends here. We're looking at the bigger picture. Now you can see that we did break up above one for the first time in many, many months. Let's actually zoom in to a 2-year basis here. So we have managed to get some upside momentum. Profits were taken. You can see that as the profits start getting taken, the uptrend starts to cool off just a little bit. Now, the other thing to note is that as we've pulled back in this week, we've seen a SOPR fall down below a value of one. That means that on average, if you look at the coins that are transacting right now, on average, they are locking in a loss. And that's really what we mentioned before. There's a lot of people trapped up here with coins bought much, much higher. And that's why that old supplier realized price is so important, because it's telling us that we're at the average acquisition price for a bunch of people who've seen red for a long time, and they just might be uncertain about what comes next. And thus they start to take profits, and they also take losses. They're willing to take that exit liquidity, just, well, price is up, I'm just going to take it before it goes lower. There's a psychological element that comes into all of this. So really the question is, does this thing actually reverse and get back above one, showing that that profit returns? And if that profit returns, it means that there's demand coming in to absorb those profits. And ideally, you would also see momentum tick up. So you can start to see that you want all of these things to start reversing at the same time. Otherwise, you tend to sit there and go, maybe we keep our bear market glasses on just for now until we see these things really start to reverse in earnest. Now, the last metric I'm going to touch on is very similar to SOPR in the way that you consider it. You can see these retests of the underside during bears. You can also see retests of the of a value of one during more bullish markets. This one here is literally taking a ratio between the realized profit and the realized loss. So where SOPR is going to account just for the average coin, this here is going to look at the average USD value in total. So it's going to account for whales, it's going to account for shrimp to a smaller extent, it's going to account for shrimp in much larger size. It's going to account for how much value is actually flowing through the network. Now, what you can see, similar to 2019, 2019 was much larger, but we had a significant break above, and then we came back down and retested. But note that we actually started to return into green territory. We got these positive retests. This is over several weeks and months, mind you. This is on a big picture scale. But overall, 2019 was showing that there was a net uptrend in overall profit being taken, and thus demand flowing in to absorb those profits. Here we are in 2015, a similar story. We start to trend higher as profits move back into the system, and we're seeing more and more investors coming in to soak up those profits. So in our current market structure, let's go on a 5-year basis for this one, we have had the initial wave of capital. There has been profits being taken, and that is it's a prerequisite really for a more positive market. But as you can see, we have come back down, and there were more losses than profits being realized over the last week. So we are in this retest phase. We're kind of at a bit of a decision point. We've seen the market rejecting some of those key levels. And the question is, does that bear market kind of hangover come back in and spook people again? Do we actually see that transition? We're still in that long grinding process of working out, are we transitioning out of a bear? Or is this in fact just another phase of the bear? So really what we do want to see is this thing start to bounce higher, showing those profits returning to the system. If on the other hand, we start to see these things accelerate to the downside, you start seeing that generally speaking, people who are in loss are panicking, and they're saying, actually, you know what, this thing could be going lower, and start actually bailing out. So it's really about understanding the sentiment. You're looking for the momentum of these things. You're looking for reversals on macro and micro timescale. So just like price, these things will reverse on the smallest time frame and propagate to larger time frames. The larger time frames give you much, much more signal, but they're much, much slower. The smaller time frames are much, much noisier. And when I talk about time frames, you can also consider this in terms of moving averages. So on a 14-day, that's going to be a much, much slower but higher conviction. When it's green, it typically stays green. When it's red, it typically stays red. If you bring this down to a 7-day, you're going to get lots more noise, lots more false breaks, but it will be much more responsive. So it's a bit of a trade-off, the same way that reading price action is. So thanks everyone for tuning in for that session. Hopefully you enjoyed it and learned something new, particularly about understanding the adjustment for Nupal and for MVRV. Now, if you did miss it, we recently released a mastering MVRV dashboard for both Bitcoin and Ethereum. You'll find them in dashboards underneath the profit and loss section, also in the description below. Strongly recommend checking those out alongside the report that goes with it. And also be sure to check out our new on-chain signal, which again, you'll also find in the description below, which is helping us pick those tops and bottoms and builds off the concept that we do here in the mastering MVRV dashboard. So until next week, I'll see you then. Cheers. So for this particular session, we're going to be actually focusing on one single metric. It's a crowd favorite, the MVRV ratio. This is a tool that has been around really since the origins of on-chain analysis. You know, it kind of comes from the realized price and the realized cap, which really are some of the most foundational metrics, and to this day carry some of the most significance. The MVRV ratio is then a derivative of that, originally developed by Murad Mammadov and Dave Puel. So this is something that's kind of been around for a long time, but at least in my experience as an analyst, is massively underexplored and underappreciated in many regards. So what we're going to look at today is kind of a bit of a snapshot and a deep dive into the MVRV, really exploring some of the different profiles of what we can do with it. We will do about 30 minutes of content, and then we'll close out with a session of Q&A. So if you do have any questions, there is a question form in this Zoom call, so do feel free to put those questions in, and we will come through and get to them at the end. All right, let's get stuck into it. So the humble MVRV ratio. So this is one of the most popular metrics. As I mentioned, it's been around for pretty much as long as on-chain analysis as a discipline has been itself. And really lots of people look at it as a macro oscillator, which it of course is. But under the surface, when we actually digest and understand what exactly the MVRV ratio is doing, what is it presenting us? What does up mean and down mean, and high values and low values? When you actually look at the underlying bones of what this thing is doing, it is providing us a view on the unrealized profit and loss held within the entire Bitcoin network. So the way to think about this, and for any of you who've been kind of absorbing our video content or our webinars in the past, you'll know that I love to bring in the layer of human psychology. So if the MVRV ratio is basically charting out current price, which is market value, spot price, market cap, divided by realized price, which we often consider to be the acquisition price. So the current value divided by the acquisition value, that will give you a profit multiple. When it's above 1, it's going to give you we are in profit. When it's below 1, it's going to give you we are in loss on average. And the psychological concept here is that at some point in time, everybody sees a green enough number in their portfolio that they feel motivated to sell. And likewise, at the very, very bottom of bear markets, there's only so much pain that the human can take. And when we look at our financial portfolio and it's just red, 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 at some point in time, that elicits the same response of people flushing out their coins. So that's why it tends to work on these extremes. We're looking at points in time when people become exceedingly likely to distribute their coins, and that generally triggers some kind of cycle change. So what we're going to do in this particular session is focus on that kind of core properties. We'll explore just the vanilla MVRV itself. We're going to look at some probabilistic frameworks and some tooling and just kind of ways that I think about these types of metrics. We're going to look at how we can actually identify market extremes and actually convert that into pricing levels, right? Which just makes it a bit easier. It's the same data, but presented in a different way. And we'll also look at market trends and divergences. So there's a lot going on in terms of what the MVRV is capable of, more than just an oscillator that goes up in bulls and down in bears. So let's get into Glassnode Studio and we will start this thing off. So all of the charts that you'll see today, we do have a dashboard here. We actually have one for both Bitcoin and Ethereum. You'll find it in our dashboard suite under profit and loss for both of those assets. And there is actually a report here, Mastering the MVRV Ratio, which will take you through those elements. But obviously, you know, it's a bit more fun to do it live in the session. So let's jump into Studio itself. This is the humble MVRV ratio. You'll see that we do have a dashed line down here at a value of 1. That is essentially the break-even level. So I mentioned that MVRV is an unrealized profit and loss multiple. Look at all of the coins in the market, how much profit is the system in if it's above 1, and how much loss is it in if it's below 1. And as I said, it does trend, right? Obviously between bull markets and bear markets. But really, for most people, when we look at this kind of thing, if we just bring into that frame of reference of a macro oscillator, what we're really looking for is extreme values. What do we actually consider to be a blow-off top type territory? And what do we consider to be undervalued? Right now, some of these, when you kind of eyeball things in, you can say, well, okay, if it's below 1, it's probably, and we typically see it down near cycle lows, 2018 and 2015. And when it gets above maybe 2.4 or 3, that's typically getting into some overheated territory. But what I want to do is bring this a step forward and apply some kind of a framework to actually measuring that, right? Because it's all well and good to eyeball in a number and say, yeah, it's high. But what does that actually mean from a more mechanical and systematic perspective? So there's another thing we can do here with the MVRV. This is kind of the first, just a very, very simple model that we can use to actually track trends, right? So we can take this thing and look at extremes. We can also look at trends. So this here is just plotting the MVRV ratio against its 1-year moving average. And you will notice that in the week on chain and in many of our reports, we will do this, we call this momentum typically, where we're looking at a faster moving average, maybe a monthly, or in this case, just the raw metric itself, and its 1-year moving average, because that's kind of the longer term baseline. So what we're doing here is measuring when do we get these periods where the cycle has changed. Now, why this is really important, you'll notice here in 2017 and in May 2021, and even back here in 2013, note that we drop very, very quickly, and it typically breaks through that 1-year moving average with some conviction. And this is after spending a significant amount of time above it. The reason why is that, remember, this is a unrealized profit multiple. We're coming off a level where the market is extremely in profit, but then suddenly is extremely not in profit. And remember, in this market cycle up here, we actually, here was the previous correction up here about 6,000, 7,000 before the final parabolic run. We traded down to that same level. But you can see that the profitability of the entire market absolutely collapsed. So if you think about that, price has gone up, gone to a very high profit multiple, but then collapsed well and truly below where it came from. So there is much less, significantly less profit in the system following that event. This can only happen when there's been a lot of redistribution. Coins have been transferred on this final parabolic run. Many coins have gone from a cost basis of $200, $300, $500, $1,000, $3,000 up to a cost basis of $20,000. So now that you have coins at a much higher cost basis, the MVRV ratio, this momentum break to the downside, is signaling that we probably have a significant trend shift underway. The same is true when we come to these upside moves. In 2019 was a great example, 2015 another great example. Typically when it breaks above that 1-year moving average, it is generally because there's a whole lot of people who've just capitulated out, their coins have been distributed to the lows, somebody else has come in and actually acquired those coins, there's been a changing of hands, and you'll often hear me say that it is much easier to hold a coin when you're in the green than it is when you're deep in the red. What we're seeing is that switching over of psychology. There's new buyers, new holders. The market has essentially reestablished a new equilibrium. So what we get is these very, very sharp breaks to the upside actually creates a degree of profitability that we haven't seen for a long time. It's a trend shift. So in a really, really simple mechanic, we're actually looking for those sharp moves that typically signal a bit of a trend shift in the overall market. But in the underlying fundamentals, it's actually a whole bunch of people who were in profit suddenly are in a loss, or at bottoms, it's a whole lot of people who are in a loss, capitulating out, and then returning to a profit. So we're seeing this kind of changing of hands showing up in the MVRV ratio. Now, the other thing I want to touch on just quickly before we get into some of the statistics is a bit of the mechanics, so we just understand what's going on here. That concept that we just talked about in terms of shifting profitability, this happens on both a macro and a micro timescale. So this chart here, we've got two traces. We've got the realized cap itself, which is obviously what the MVRV is derived from. It's kind of the on-chain cost basis is the right way to think about this. It's the valuing every coin at the price when it last moved. And then in the green, we've got realized profit. Now, what that means is if a coin was bought at 5,000 and it's spent at 10,000, there's a $5,000 profit times the coin size, right? 0.5 BTC or whatever it is that's on the move. Now, what you'll see is that during periods of heavy profit taking, this realized cap will climb because people are revaluing cheap coins to expensive coins, quite often selling to a buyer who it's their first coin. Bull markets are very common for the smart money from the previous bear market to have very cheap coins, basically doing the exact opposite of what the market should be doing, which is the new money coming in and saying, hey, I love this $60,000 Bitcoin, despite the fact that in many instances it's the exact wrong time. Now you can see that there was this second leg. We had this second rally from August through to November 2021. And we've covered this quite a bit. This is a bit of a funny rally. It didn't really have the momentum behind it. And we're going to discuss what was going on there. But you can see that we had this second rally, these extra profits were taken, and we had a second push higher. The 2022 bear market, we then essentially flushed out all of that capital and we returned. We essentially flushed out all that excess speculative premium, got removed from the market. But the important thing to note is that the peak profits were occurring at the exact top, which is literally profit taking. And that's those coins getting transferred up to a higher level, higher cost basis, more price sensitive. So we can look at that concept and the signals that the MVRV is telling us on a macro and a micro scale. So on the left-hand side here, this is the macro scale. What we're looking at here is MVRV between the two 2021 peaks. Now, price was at a higher level in October and November, but there was less profit. You can see this big negative divergence that's in play. There is less profit in the system despite price being higher. And you have to wonder, well, how does that happen? Because the average cost basis of the market was much higher. There was literally less profit in the system because the average cost basis was up at a higher level. And the reason why that cost basis was at a higher level is because a whole stack of people took profits on one and then two peaks. So what this is really describing, this big negative divergence here, is describing a top-heavy market. You're seeing a situation where price is higher, but there's less profit. You've got a top-heavy market. There's lots of coins located up in that $50,000, $60,000 realm. And then you can basically, when price falls below that, you have a much more sensitive market. Any kind of price below, suddenly people start going, hang on a second, I'm no longer in the green. And people start to get panicky, and then the bear market ensues. And naturally, these things all happen within the context of everything else, right? You've got macro and various other indicators. But essentially, this is providing you a nice framework to say, well, at the very least, within the context of Bitcoin, I know that this market is far more sensitive right now at this all-time high than we were at the previous one. So it gives you a bit of a context. Now, let's flip that around. Let's just imagine in 12 months, 18 months, 2 years' time, we're back up at all-time high, right? 70,000. Because there's going to be a whole lot of those coins bought at 50, 60,000 that have been reallocated down at here at 20 or 30 or 40. This MVRV ratio, in theory, should be much higher. If, on the other hand, we get up to that all-time high, if price gets back to 70,000, and we have yet again another very low MVRV ratio, you start saying, hang on a second, and we've also got profits being taken. You start to think maybe this thing doesn't quite have the legs yet, because you're seeing people distributing and basically taking those profits. Now that same concept applies at a micro scale as well. You can see here in the April to May 2021 peak, higher and higher highs in price, but decaying profitability. This is literally the process of distribution taking place, which you can see distribution taking place as profits were taken, all the way through this topping pattern, which, as we all know, how that story played out. And we can actually see this in our 2013 and 2017 cycle as well. In 2013, price actually rallied between the two peaks. It was up 392%. And yet MVRV at the all-time highs was actually lower. So even though price was up 392%, the amount of unrealized profit in the system was much less. 2017, very, very similar story. We got up to these levels and we started seeing a decaying or a weakening of our overall MVRV, despite price being up 65%, 56%, and then blow off top. And actually, you can see at the all-time high itself, we also had a negative divergence. So the MVRV can be used to try and gauge risk in this market as things are starting to devolve and you're seeing coins transferring around the system. This is kind of at a macro and a micro scale. You can start to observe whereabouts the system is in terms of that profit taking when you've got risk in the market, top heavy, and obviously you can then break this down into various cohorts and look at this in even more detail. Okay, so that's kind of the concept and the structure and what the MVRV at a big picture, just some, some of the use cases that certainly I pay attention to. What we're going to do now is a bit of an exercise to show you how I think about probability, right? How do we make this a more actionable tool? Because it's all well and good to be looking at divergences and getting really in the weeds, but for many people, we're just looking for what classifies as an extreme value. Now, the first approach that I mentioned before is just to eyeball in some levels. So here I've put in some levels here at 3.2 at the top, 2.4, right? Two levels that kind of represent like super overheated and hot. And I've also got levels here at 1, which is actually break-even price or at the MVRV, and then 0.8, which is a 20% discount. Now, these are just eyeballed in, right? I've just kind of picked numbers that seem to catch, oh, that looks about right. But obviously the market can change and evolve over time. So it's not the most robust system, but the concept will still carry forward. So now that we've got these levels, how do we actually assign a probability framework? How do I give some kind of robust level to say, well, maybe that will work, and with what kind of percentage probability? So a tool that I like to use, this is in Workbench, we're using an if statement here. What I'm basically saying is that let's just take the level of 3.2, which is our red curve. If MVRV is above that level, return 1. If MVRV is below that level, return 0. So for every trading day, and I'm going to do a cumulative sum. So for every trading day, let's say there's been 300 days out of the 6,000 that Bitcoin's been trading, that we've been above it. I've got a ratio of 300 days above, 6,000 below. Give me that as a percentage. That's essentially what this metric is doing for those 4 different levels. So the way to think about this, let's take our red curve here. At our current level, we're somewhere between 6.5, 7, kind of in that ballpark. You can see it's actually been quite stable for more than 5 years now. So we're talking about somewhere between, let's just say 5 and 7% of all trading days have been above that level. Well, that means that 95% of all trading days have been below it. So if I see an MVRV that's above 3.2, I know that there's only 5% of all history. And the logic here, only 5% of the time have investors been willing to sit there and go, I love this green portfolio, and not put a top in. So when I'm above that level, we're talking about a fairly improbable scenario. When I'm below that level, that's kind of the mean. That's the norm. 95% of the time, we're below that. So therefore, human behavior is probably going to start stepping in when you get above that level. Likewise for the blue curve, this is the one 20% below. The market's at a 20% loss. This one here, we're talking about 3.9%, 4%, 5%. So similar ballpark. For round numbers, let's just say 5%. 95% of the time, MVRV is greater than 0.8. So therefore, if we reach a number that's at 0.8, it's an improbable scenario. We can start to assign probabilities to these things. And you will see here that, yes, I eyeballed in those horizontal levels, but they're also rough. There's a bit of logic and thought behind it. Our very extreme, both to the upside and downside level, about 5%, meaning 95% probability that we're outside those bounds. For the other two, somewhere between about 15 and 20%, right? So I'm looking for things that represent extremely overheated with 5% probability, and stuff that's starting to get hot or cold, which is in that 15 to 20% type range. But this is just a really simple framework to understand how likely is it that this level is going to be hit or tagged. So what we can then do is use the if statement to essentially put some really nice color bands onto this thing. And we can start to identify periods where we are in heated and overheated territory, or we are in cool and extremely cool territory. So we can use that tool to then say if price or MVRV is below 0.8, it means that I have a 95% probability that it wants to be higher than 0.8 over any kind of long term. Now, naturally, all of this assumes that MVRV continues to do what it does. But the nice thing about it is that we're essentially basing it in one of the most fundamental metrics, which is the realized price. And the realized price is going to react to every single transaction on chain. So therefore, your assumptions boil down to if people continue to move coins around on chain at a meaningful level, then we can expect that this thing will continue to represent some kind of unrealized profit and loss ratio. So we're trying to simplify and nullify risks of this thing deviating over the long term. But the other assumption we've got here is we've just eyeballed in horizontal levels. Well, what happens if Bitcoin really does grow and we end up at a 10 trillion or $100 trillion asset and volatility squeezes out and profit multiples of 320% no longer really matter? What happens if our base assumption here is that those horizontal levels is actually, that's kind of the weakest point in this analysis, because we've eyeballed it in and we're just kind of hoping that those horizontal levels remain long term. So we'll come back to that in a second. The last thing that we can do is, because all the MVRV is just a ratio between spot price and the realized price, well, if we've got an MVRV of 2, that means that price is trading at 2 times the realized price. So you can actually multiply. We've now got our 4 extreme levels, 3.2, 2.4, 1, and 0.8. Let's multiply the realized price by that to develop pricing levels. So what this is essentially capturing, and you can actually see these levels where things got really heated in 2017, things got really heated in 2021. This is the price level where there's only a 5% chance that we've ever been above it. It's basically saying that if you reach that kind of pricing level, that's where the human behavior that we've been talking about, the I'm in so much profit, I need to take it, or I'm in so much loss, I need to get out of this thing. We're looking at the pricing levels where we would typically see that type of behavior kick into gear. So it's just giving us a bit of a frame of reference on where we sit within the market. And what I like, you can see here that during the bear market, we tend to sit between these 2 behavior levels. And then we go through this long process of transitioning up to the heated zone. And once we break into this heated zone, typically speaking, here we are in December 2020, here we are back here in early 2017, we're typically breaking the previous all-time high. So generally speaking, we see lots of things kick into gear. Bitcoin is just surprisingly cyclical. As we break the previous all-time high, smart money starts to distribute in larger size. It starts showing up in headlines, new buyers come in, and you go through this extreme. It's like this big kind of TikTok that goes back to front, where you see all of the bull market mania shows up, and then you cool down and you have all the bear market catastrophe. And these things tend to show up in very, very similar cyclical patterns. So in order to address the horizontal level problem, which is basically the most arbitrary part of what we've got here, we can actually use a bit more robust and meaningful methodology. So the blue curve that I've got here, and again, I'm using Workbench to calculate this. I'm just doing a cumulative mean. This is basically calculating the all-time average. What is the all-time average of MVRV? And this is essentially going to follow as MVRV evolves. You can see it's actually quite stable over time. But as MVRV evolves and changes and moves over time, this thing will follow and adjust. You can also set this to like a 4-year basis. So I've got some ghost traces here to show you what we do if we do a 4-year average. There's all sorts of things we can do, but for the sake of simplicity, we're just going to do an all-time average. Now, for those who are familiar with statistics, we can also then measure how many standard deviations above, in this instance, 1 above in the red, or 1 standard deviation below in the green. You can start to set up, okay, show me a statistically meaningful deviation. When are we actually well and truly outside those boundaries? Now, of course, there's a little bit of arbitrary. What classifies as significant? One standard deviation, two, half. That kind of number then comes into it. But very typically, if we're looking at plus or minus one standard deviation, it will give us a reasonable bound. And that's where we're going to keep it simple here. But we're essentially, it's a bit more of a statistical framework rather than just a horizontal level and kind of finger in the air, measuring days and things like that. So what we can then do is calculate via that exact same methodology. Let's just use our mean plus one standard deviation in the red, mean minus one standard deviation in the blue. And again, you can start to identify periods in time where the MVRV is extremely hot. We're seeing there's a lot of profit in the system. People are more likely to start spending. Likewise, during our bottoms, we're seeing that point in time when there's so much red that people start flushing out. You get a changing of hands, and that typically puts in a cycle change in both directions. Now, naturally, you can compare this to that momentum oscillator we looked at the start, and you can start seeing how MVRV just by itself gives us a really, really nice framework for what's going on across the market. You start getting confluence across many of these elements. Have we seen a trend shift? Have we seen a bunch of profitability drop out of the market? Have we seen that we're at a 1.2 or 1.5 standard deviation from the mean? You can start gluing these pieces together and saying, do we have all of these divergences in play? And thus a cycle change may well be underway. And again, it's based on that human behavior pattern. And we can also calculate by the exact same mean a series of pricing bands, right? Plus or minus whatever standard deviation level we want to look at. Here I've just plotted out -1, -0.5, +0.5, +1. But you can see we essentially achieve a very, very similar result where you can start looking for periods in time when the market is just well and truly out of bounds. And it's time to just start saying, yeah, this is getting pretty heated. Start looking for those divergences, right? We're above this red band. You can see in 2017, for example, we were above this level for some time. So we can persist in an overheated state for some time. Likewise at the bear market, we can be down here for several months, 6 months, 8 months. These are not short-term things, but it's a signal to start maybe looking for those divergences in the opposite direction, right? So it gives you a bit of a framework to say, all right, now I can start thinking about, are we in superheated territory? And what are the metrics I need to then look at from that point onwards? And likewise, when you're at lows of bears, you can start changing that framework and saying, all right, start looking for that capitulation behavior, start looking for that changing of hands, sharp moves in percent supply and profit, things like that. So it just helps you orient yourself within the maze of markets. So that framework that I just walked you through, that concept of taking standard deviation bands and different levels in terms of what we're looking at in terms of statistical levels, we can apply that not only to MVRV, we can also apply that to many other oscillators with a little bit of work here and there. But the other day we actually released this dashboard, which glues together that exact same framework using the cumulative mean and the standard deviations for four crowd favorite metrics. MVRV ratio, which is unrealized profit and loss. We're trying to capture different segments of the market. So is the market in an extreme level of profit or loss on paper? SOPA, which is saying, is the market locking in extreme profit or loss on both sides? The pure multiple, which is then saying, are miner revenues at some kind of extreme? Are the production side, typically miners are operating at the extremes. At the bottom of a bear market, they're selling into an already weak market, they're capitulating, they have to empty their balance sheets, they're under extraordinary stress. And in a bull market, they're mining coins, typically at a power price that's much lower than the current price. And as price goes higher, those 900 BTC become an increasingly large USD sell side. So we're looking at the mining perspective or the production side. And the last one is the reserve risk, which is capturing the amount of hodling that's taking place. So essentially, we can start to distill all four of these to say, do we have all four of them out of bounds? And that's what this signal is trying to capture. It's trying to pick up points in time when we have miners in an extreme amount of profit. We have the markets in an extreme amount of profit. People are taking extreme profits. And the amount of hodling is pretty much at an all-time low, pushing reserve risk higher. So when you have all of those conditions, it starts looking like you have some kind of market cycle peak. When you have all four of those conditions in the exact opposite, everybody's underwater. Everybody who's selling is doing so at a significant loss. the miners are under extraordinary pressure and their revenues are wrecked. And then the last component is hodling at all-time high, because the hodlers are the ones willing to step in during the most bearish price action. So this tool, which you'll find under our signals section, again, this is all available for our advanced members, is essentially distilling down those concepts for each of these 4 metrics using our mean and plus or minus standard deviation bands, and then just simply aggregating them together. So that's the snapshot or the run through of just some of the many things you can do with the MV/RV ratio. Let me just jump back to my cover slide, because we will start to move into some questions. So as I mentioned, everything that we just went through in that session is contained within that MV/RV report. And you will also see there's the live dashboard for both Bitcoin and Ethereum covering every single step of that process. And then that signals dashboard is also now live for all advanced members. So you can, there's a free trial to get you started with advanced. But really that's what we're trying to do, is break down these concepts, help apply a bit of a probability framework to things, help people use these tools to navigate market extremes. And there's lots of ways you can use it. You can use it for just spotting market extremes. You can use it for trying to just change your bull versus bear market thinking. You can use it as a bit of a compass to try and just work out whereabouts we are in the cycle. But really, at the end of the day, it comes down to at what level do we engage and kind of fire up people to make the same decisions. And this is the thing I try to impress upon people. For on-chain analysis is just a beautiful tool for visualizing human behavior. And while the asset may change, the year may change, the market may change, Jay Powell's comments may change, all these things in the world will change. But the reason we can still chart price action back in the 1920s and it looks exactly the same as today is essentially because the human behavior pattern, our response to fear and greed and profit and loss are pretty much the same, right? The human ape brain doesn't change, despite the fact that the asset and everything else does. So on-chain analysis is just the first time we can actually see this printed out block by block for these assets, which are just incredibly emotive, right? That's kind of the part of the nature of these things. So with that said, let's move across to question and answer and see if there's any queries that have come up. Let me find the Q&A tab. Okay. Okay, so first question here, can you please explain young supply realized price and old supply realized price in the last research report? Great question. So what we're looking at here is, let's start with old supply. When we're looking at old supply and young supply, or long-term and short-term supply, what we're really doing is trying to understand the different components of the market. And if we did some research some time back now, actually, I think 2020, that was kind of associated with our long-term, short-term supply. And the concept here is that when we look at, statistically speaking, when you look at all of the coins within the Bitcoin network, generally speaking, those that are older than 5 or 6 months, somewhere around the threshold, about 150, 155 days, the probability that they get spent is significantly lower. It declines below 1%. It's like a very rapid decay. So any coin that's older than 5 or 6 months, it's very improbable. Similar concept that we just looked at in terms of probabilities, it is unlikely on a relative basis they get spent. Conversely, the young supply, the coins that are younger than that 5-6 month threshold, those coins make up the vast majority, like 99 point something percent. So what you're basically looking at there is that those coins make up the vast majority, like 99 point something percent. So what you're basically looking at there is that the young suppliers, you can also think about like the liquid or the active or the mobile. Young supply is the stuff that's always churning. And if you think about it from this perspective, I don't particularly care. As a trader or an analyst, I don't particularly care that the guy who bought yesterday sold today, or the guy that bought 2 days ago sold today, because it's all just kind of part of the mix, right? It's part of the daily trade volume. What actually matters is the guy who bought his coins 5 months, 6 months, 1 year, 5 years. What happens if a bunch of those old supply start spending? So when we're looking at their realized price, what we're doing is breaking these out into age-based and therefore probability-based cohorts. And what we've seen historically through Bitcoin's market cycle is that those old supply, the older hands, the people who essentially have held their coins for a long period of time, generally speaking, they start distributing and spending their coins en masse during two particular events. One, when we break above the previous all-time high. Generally speaking, those longer-term holders start spending en masse because they see that Bitcoin is getting expensive. They bought their coins much cheaper and they start realizing profits into the raging bull market. The other place that we see them spending is actually, well, maybe not quite so much right now, but certainly a couple of months ago, we see them at the very, very bottom. Why? Because bear markets typically last for longer than 5 to 6 months. In this case, and by my count, I believe that the bear market started in May 2021. That's kind of when the psychology shifted, which what MVRV also showed us as well. That psychology changed. Those old hands, 5 to 6 months, are actually top buyers at that point in time. People who bought during the 2020 to 21 cycle or 22 cycle, they typically become the old hands, the old supply. And you can see that their realized price will go up and up and up. And the higher it goes, it's showing you that the average acquisition price of those buyers is substantially higher. So what we're looking for there is that young supply typically follows the price. It's much more responsive because it's daily churn. The old supply realized price is trying to capture those folks who essentially are either the smart money who bought in the bear and are selling in the bull, or the people who had bought at the top and have finally just seen enough. They often drive that price action at the extremes, whereas the young supply kind of picks up all the daily trade and the daily momentum, how that works out. Okay. So question here, which exchanges are used to calculate BTC prices and volumes? What percent of transactions do I believe are captured by the above? And are these all on-chain transfers? So for what we're doing, we use an aggregated price. So in terms of what the spot price is, generally speaking, I mean, Bitcoin's a bit of a unique asset because generally a stock trades on the New York Stock Exchange, and that's kind of its home. That's where it lives. That's where its price action happens. Bitcoin is unique in the sense, well, this industry, digital assets are unique in that they trade all over the place in different places around the world. So we use an aggregator price to try and map out where that is. In many instances, it's kind of, plus or minus. It doesn't, the actual delta in terms of what the precise price is. As long as you're not looking at an exchange that's got extraordinarily high spreads, we typically see that between the major exchanges, which form the bulk of the pricing, you typically get arbitrage that keeps them very, very close together over time. The realized price is then looking at the price at the point when each coin moved. So at a block by block level, we look at each UTXO and we assign the price when it was transacted, because each transaction has a timestamp. The block that transaction is in has a timestamp. So we take that timestamp, we assess what the price was at that time, and we assign it to that UTXO. And from that point, when it's spent again and mined into a block, we can measure the price delta and therefore the value delta. So it is the MVRV, spot price, market cap, off-chain. Realized price, realized cap in the denominator, on-chain. And we're gluing those two together. So it's a bit of a meld between those two. The other way, actually, just one final point on that to think about this. For MVRV, you've got market value, which is basically the price that everybody sees, right? And then you've got the realized price, which is actually individual. What we do is we aggregate it to be a holistic view of the whole market. But my realized price is different to your realized price because you and I acquired our coins at different times. So the realized price is actually, it's much more divergent. Actually, every single coin has its own realized price. What we're doing with MVRV is gluing these things all together and just looking at an average across the whole market. And bringing it back to that previous point, we can do short-term holder MVRV, only looking at the profit and loss held by recently moved supply. Or we can do long-term holder MVRV, only looking at the overall behavior of coins that are held by older hands. So you can actually break that down even further. Okay, how would I classify MVRV divergences for daily analysis and swing trades? Is it a leading or a lagging indicator? It can actually be both. So, and again, it kind of depends where you sit in the cycle, you can see that those divergences, basically what you're looking at is at these peaks, it's about relative levels, right? Are we seeing more profit enter the system as price goes higher? As we come out of bear markets, small price changes, and you'll see this in things like percent supply and profit as well. As you start to come off the lows, a very small price change, 10%, can create 13, 14, 15, 20% increases in the amount of supply and profit. So during those transition points, typically MVRV is very, very responsive, right? The amount of movement is very responsive. Over the macro scale, that's where you look for these just much larger divergences. So it does actually work as you bring it down to finer timeframes. You will see these things like, does the percent change of MVRV match the percent change of price? So you can go down to actually quite fine detail, and even within micro peaks and things like that. So certainly it will tell you what's going on in those certain levels. But remember, the underlying basis is we're looking at changes in coin distribution. Small changes in coin distribution may not change the market very much, but at market cycle tops, you get the most extreme changes. You get very, very large sums being distributed near the top. So it kind of scales alongside the market. When we're just kind of day-to-day chop, MVRV will be less responsive because the difference between the market being in 130% profit and 140% profit, but the difference between being in 240% and 320%, that's a very significant change that typically happens over a very, very short time scale. So it does kind of change. Okay, so a question here on the link between MVRV Z-score and the probability lines. So the Z-score is literally plotting out how many standard deviations we are. So that second version where I have the cumulative mean and then cumulative mean plus or minus one standard deviation, MVRV Z-score is literally plotting out how many standard deviations we are away. So if MVRV Z is at 1, that means we are at that top +1 standard deviation band. If we're at MVRV Z is at -1, it means we're at that lower level. that blue band. So it's actually plotting this out in a pure statistical framework. That's exactly what MVRVZ is doing. Is there a way to use MVRV to spot the Pico top of the cycle? It seems price keeps going up even when it's in red territory. So the answer is there is no metric tool answer to the Pico top. And looking for one is generally the problem is that if you look for too many of these things, trying to look for the Pico top, the reality is the market could do something completely different, right? And if there was a perfect answer to these things, everybody would be rich and we wouldn't have to sit here in a webinar. The concept here, you're absolutely right. It will break above that red band. And remember, the selection of that +1 standard deviation, that's the arbitrary decision that we made for this. And the reason why is you just do plus or minus 1. And we're trying to spot just overheated conditions. You could refine that. You could use MVRV Z-score and you could look for levels. You could look for levels that are within your framework, right? You could actually have a level for +1, +1.5, +2, and you can establish, like, the higher this thing goes. Remember that probability framework. 95% of the time, we're below it, but there's still 5% where we're above, and sometimes we're much above. What if that was 2% or 1% or 0.5%? The thing, what you're doing there is you will start getting into Pico top territory, so to speak. If you keep incrementing up how high do you want to go? The trade-off is that the more your percentage goes down to 1%, 0.5%, you may not hit it. So if that makes sense, you may actually not get to that level because the market just happens to be different that particular cycle. So the answer is you can do that, but the challenge is you're then reducing the probability that event happens in the first place. So, you know, there's no solutions, only trade-offs. It certainly falls into that bucket. Okay, great question here. Can you unpack the realized price calculation given how much of the acquisitions BTC take place off-chain? Fantastic question. There is a workbench chart or a couple of workbench charts in our presets under the exchanges category, and they are designed to answer this very question. A lot of people don't realize this, but every single day, hundreds of millions to billions of dollars of Bitcoin flows in and out, both directions. So when you look at exchange net flows, it's like, you know, 3,000 Bitcoin, 4,000 Bitcoin, 10,000 Bitcoin's a big day, but that's net. That's inflows minus outflows. Inflows are typically like 50, 60, 80, 100,000 BTC. And outflows are 50, 60, 80, 100,000 BTC. So this is actually a question that I contended with quite a bit in the 2021-22 cycle, as I myself am growing as an analyst. I was trying to understand this question because I saw lots of people saying, you know, oh, all the trading happens off chain. Well, that's true. But the inflows and outflows is typically somewhere between like 30 and sometimes 70% of spot volume. It's huge. So there is a stack of volume flowing in and out. The other thing with Bitcoin is that the data is quite clean in the sense that there's not that many DEXs, certainly not ones with any kind of significant volume on Bitcoin. So when people are buying and selling, those coins are still going in and out of exchange. So the way to think about this, the realized price, if you look at the realized price on an individual basis, I may buy my coins at 30,000 and then I may withdraw them at 40,000. So the on-chain transaction will pick up a $10,000 difference. But I still made a decision to withdraw at 40,000. I didn't sell, I chose to withdraw it. And then when I send it back, I kind of don't have a choice, right? You're going to see it because it's on chain. So in many ways, when you look at it at an individual level, yeah, there's some error bars. But when you look at it in scale, over time, in aggregate, you still see these patterns play out time and time again. And a lot of this is driven by the fact that the coin volume flowing in and out is just truly extraordinary. So if you do want to have a look at this, there's a USD and a BTC version of this. Go and look at on Workbench under exchanges, look at how small net flow is, this tiny little black squiggly line compared to the green and red, which is just enormous on both sides. So that's generally how I would answer that question. Would I combine MVRV with a momentum-based oscillator? Yeah, to find support and resistance. Absolutely. MVRV is one of these really nice things to help you orient yourself. Are we in market conditions that look like we're in a more constructive environment? Are we seeing sharp changes? So in many ways, MVRV is great to actually assess and help orient yourself large. And like, for many people, help you get your longer term timeframes in check. And then you can go looking at all your other indicators within that framework. For some of you who are actually really in the weeds and looking at those micro divergences, it can then also be part of that internal framework. But really, if there's kind of a takeaway, I think for most advanced members, having this tool as kind of that grounding anchor to just understand where we are in the cycle of things is probably a nice way to go about it. We've got another question here in terms of self-transfers and consolidations. Yes, in terms of self-transfers and things, there will be some, that's again, some signal loss there. That said, we also have our entity adjusted variance, which will account for internal wallet transfers. So you can compare your standard MVRV to your entity adjusted MVRV, and that will clean up a lot of that, a lot of those internal transfers and things like that. And also exchanges and the like. But generally speaking, with exchanges, if you're looking at their hot wallets, because they're always on the move, they just kind of track price. So the way that MVRV, like the realized price for an exchange hot wallet is 1, because it's just like 1.1, 1.2, because it's just kind of moving with price. So in a way, it actually self-nullifies because it's kind of just moving around and not doing much. It's kind of the extremes that really make the MVRV sing. So in many ways, it's actually self-correcting, which is kind of neat. Great question. I get this all the time. How does tax loss harvesting affect MVRV? Tax loss harvesting will show up as a sale, right? Because somebody's moving their coins from a high price to a low price. But the other thing to think about that is that people always tax loss harvest. We're seeing the exact same behavior playing out time and time and time again. Human beings are making the same decisions collectively at the same time going, gee, it's a bear market. I'm very, very underwater. Some guy is saying, I'm going to harvest that tax at the exact same time that some other guy goes, that's it. I hate this asset. Get me out of this thing. I'm done. I'm tired of seeing this red. The same behaviors show up with each cycle. So the answer is tax loss harvesting will show up and respond to this, or MVRV will respond to that, but it always responds to that. And human beings make the same decision every single time. So again, it's kind of one of these neat little self-correcting phenomena that, yeah, it happens, but it happens every cycle. So we're comparing apples and apples. Okay, underlying assumption here of realized price is that it's essentially an acquisition. I think I kind of covered this. The answer is yes. On an individual basis, your error bars are a bit larger, but in aggregate, we continue to see that people tend to behave the same way over and over again. So it's kind of a funny situation. Can I calculate MVRV based on the API data? Yes, you can. It's literally spot price divided by realized price or market cap divided by realized cap. The only difference there is circulating supply will nullify and cancel each other out. Okay, what else do we have? Just trying to go through and find questions here that are separate. What is the name of the indicator and workbench with the only 2 bands of MVRV? It's called deviation bands. You'll find it under market indicators, I believe. If not, if you can't find anything that I went through in this presentation, dashboards, Bitcoin or Ethereum, profit and loss, and MVRV. It'll be sitting in there. Okay, let's keep going. Just trying to see if there's any more questions here that are kind of unique and different. Yeah, there's a point here about short-term and long-term holders. This is where, if you look at, in fact, in Workbench as well, you will find long-term and short-term or old and young supply MVRVs, which is just taking the ratio between their realized prices. You can use those to kind of segment the market into that hot money, cold money, and you can actually see these patterns play out time and time again. So you can compare standard MVRV, which is everybody, young supply MVRV, which is the fast hot money, and old supply MVRV, which is going to give you the older hands. And you'll see that during some periods of time, their behaviors are very similar. Typically during market extremes, they diverge significantly because the old supply is in huge profit. The young supply is they're at profit, but they're pretty much buying the top. So you'll see these things diverge, and then they'll also diverge in the opposite direction near market bottoms, because the old money is the ones from the previous cycle, all the smart old money's got out, and those old money who are left are kind of people who are holding the bag and very, very red in their portfolio. And when you start to see them recover, which we're in the process of trying to get above, that's what we covered in the week on chain. That's the general framework for those. Okay, I think that's pretty much all the questions. There's one here on sovereign rollups, which I wish that I could answer. I actually haven't looked into it enough, so I can't give you any kind of a proper response on this one. But one thing I am very excited about, and we've seen this ordinals and inscriptions start to play out, at least from my personal perspective. The most exciting thing for me is that we have a wave of innovation that has come back to Bitcoin. And this is very exciting to see. And, I fall into the camp where Bitcoin is a pretty resilient and hard to kill animal. And if, inscriptions or sovereign rollups or any of these things kill Bitcoin, then it was destined to die. I believe that the amount of innovation and interest and renewed kind of engagement that's coming to both the development but also the adoption space is very, very exciting. I think that Bitcoin will, I think it will thrive through this. We're going to learn a lot. We're going to build some cool things, and the network will expand and grow from there. And it's a resilient beast, so these things aren't going to kill it. So thank you everyone for tuning in. Hopefully you found that to be a useful session. We are looking forward to doing more of these. We'll try and get at least one more done. Hard to play out, at least from my personal perspective. The most exciting thing for me is that we have a wave of innovation that has come back to Bitcoin. And this is very exciting to see. And, I fall into the camp where Bitcoin is a pretty resilient and hard to kill animal. And if, inscriptions or sovereign rollups or any of these things kill Bitcoin, then it was destined to die. I believe that the amount of innovation and interest and renewed kind of engagement that's coming to both the development but also the and I fall into the camp where Bitcoin is a pretty resilient and hard to kill animal. And if inscriptions or sovereign rollups or any of these things kill Bitcoin, then it was destined to die. I believe that the amount of innovation and interest and renewed kind of engagement that's coming to both the development but also the adoption space is very, very exciting. I think that Bitcoin will, I think it will thrive through this. We're going to learn a lot. We're going to build some cool things, and the network will expand and grow from there. And it's a resilient beast, so these things aren't going to kill it. So thank you everyone for tuning in. Hopefully you found that to be a useful session. We are looking forward to doing more of these. We'll try and get at least one more done for the month of March. If you do have any feedback or comments or questions following this, we will actually post this video and get it live for you all. So if you have any questions at all, either jump into Glassnode forum, and ping us there, or feel free to send us a comment. But thank you for tuning in, and we will see you in the next one. Cheers. Hello everyone, and welcome to your Glassnode video report for week 11, 2023. So there is never a dull moment in this industry, is there? In the span of just 1 week, and really it was basically half a week, we saw 3 of the primary banking partners of the digital asset space essentially go into some kind of receivership or voluntarily wind down. This is a fairly significant and pretty consequential event, because it really does give a bit of a light into the current hostilities in the US regulatory environment. But really what we're going to try and assess today is what are the implications, what were the initial reactions going on from investors. We did see USDC and Circle impacted. They had about 3.3 billion. And obviously this industry does not slow down over the weekend. So during that period of time where blockchain assets continue to trade, we can see these prices and uncertainty getting priced into markets where the banking system is closed during that time. So let's get stuck into it. But quite a significant week to get talking about. So it is one of the most consequential weeks. We saw Silicon Valley Bank being the largest of the 3. Essentially went into receivership and taken over by the FDIC. This is something on the order of $200 billion bank, the 16th largest in the US and the 2nd largest bank failure. Now, it is important to note that this is not directly related to crypto. There's a lot of headlines that kind of conflate these things. There was essentially a duration mismatch with their bond portfolio, and this is a risk that is present in much of the traditional finance system. The other two is Silvergate and Signature Bank. Now, these two, for Silvergate, they've gone into voluntary wind down, where basically all deposits are going to be returned. And for Signature, this is kind of the newest one in the mix. They are also going into receivership, into the hands of the FDIC. Now, the reality here is that what we're basically seeing is the banking partners that operated with many of the exchanges, many of the crypto firms, many of the VCs, they're going to have to go through that process of re-establishing banking arrangements. So naturally, over the course of that weekend, there was an enormous amount of uncertainty. Are deposits going to be insured, which it seems at the moment they will be? So essentially, all depositors at those three institutions are going to be made whole. Equity holders and shareholders and management, on the other hand, different story. But what we've basically seen is that over that weekend, particularly in the stablecoin realm, we saw volatility in the stablecoin space really since the first time since Luna collapsed. So what we're going to look at today is that view into the stablecoin portion of the market. We're going to look at some net capital inflow, so going quite big picture to understand is capital flowing in or out of this space. We're going to look at the preference for BTC and ETH and how the market essentially responded regarding to the majors versus stablecoins. And we're going to dive into the derivative markets and have a look at a couple of short squeezes because price has essentially rebounded from here. So we've kind of had a flash down to 19,000 and then back up into the 22, 24, actually at the time of recording. So a pretty volatile couple of days, a pretty consequential week. And what we're going to do is try and assess what happened using on-chain data. So as always, please do give a like, a share, and a subscribe for this channel. It does help us get to more people. As always, do let me know in the comments if you have any questions, queries, and we'll get through those. And it really does help me understand what it is you want to see, what you enjoy, and what we can do better. So let's get stuck into the analysis. Okay, so starting with our price chart, and essentially this has been our last couple of weeks in this fairly substantial pullback. We got down to about 19,600, and we have essentially recovered the entirety of this in just a couple of days. So a very, very volatile period, and we will come back and talk a bit more about just the violence of this move and some of the underlyings when we get to the derivative section. So I'll leave it for there. Now, what we are going to start with actually is on a couple of technical pricing models. Now, you don't see me use technical analysis that often, and here we are just using simple moving averages. This is not any kind of major rocket science. But the reason why I've selected this particular chart is because technical analysis, at least the way that I look at it, typically when you've got things like the 200-week moving average, which is up here in the blue, in the red, and you've got the 1 year moving average in the blue, and then below us we have the 200-day moving average and the pi 111 day moving average sitting below. And you can see that at the moment there is a confluence where they're basically prices squeezed between these two. The reason that I look at these particular models is because everybody else is looking at these particular models. The 200-week is a very, very common tool used in traditional finance, as is the 200-day and the 1 year moving average. These are all very, very classic moving averages. And it's one of those things, there's a great saying that in a sea of sand, a single flag becomes a target. And what that basically means is when you're standing out there in the desert and everything looks the same, and there's one flag somewhere out in the desert and you can see it in your view, and everybody's going to look at it, they all move towards that same thing. So quite often these moving averages that are very popular are popular because price tends to react around them, and the reason that price reacts around them is because they're very popular. So it's essentially a game of network effects. So what's quite intriguing is that we're essentially range bound between these very, very popular and well-observed models. So therefore, should we get some kind of break above or below, that would be something that the market would observe and see and react to, and thus probably carries a bit of significance. So a really, really simple model to just pay attention to which direction do we go, and we're currently squeezed in between these things. Some kind of break above those popular models would probably be indicative. It would give us a bit of a view on what the market's preference is, and lots of people will see that particular event. Now, moving on to the stablecoin space. So it's very, very uncommon that we get a nice volatile chart when it comes to stablecoins, but in this instance we did. So what essentially happened is about 3.3 billion of Circle's capital was confirmed to be within Silicon Valley Bank. Now that has been fully determined to be it's recoverable essentially. So we've seen the peg for all of these stablecoins recover. But this is all occurring on a weekend. So what we've basically seen is the market traded down to approximately the discount, 88 cents, about 12% discount. It's approximately what the market was estimating, the probability times the risk and the consequence, trying to understand what is the risk that Circle or USDC is no longer backed one-to-one. Now, we also saw DAI here in purple trade down, not quite as low, but certainly followed USDC down. And this is primarily driven by the fact that about 65% of DAI is actually backed by USDC, as well as other stablecoins, which we can also see start to depeg to the downside. This is a GUSD and Paxos USDP. Now, we did see a bit of a premium emerge in Tether, interestingly enough. It's kind of one of these interesting ironies that capital flows towards Tether, which tends to have one of the more, question marks around its history and its past. There's typically where a lot of, there's a lot of critiques around Tether and their transparency, and it's kind of ironic that during a time when a regulated banking institution in the United States is having issues, capital flows towards the asset that has higher lending. It's one of these interesting dynamics that we see play out. BUSD had a very, very slight premium, but as I said, they have all essentially converged back to their par level, and this is essentially a result of all their collaterals being confirmed to be A-OK. Nevertheless, to me at least, the very interesting dynamic was seeing how quickly DAI and how closely DAI followed USDC. So really, it kind of demonstrates there's a bit of a tethering between what's going on in the decentralized finance industry and the traditional finance industry just on the basis of the collateral. Now, as a result, we saw Tether dominance climb back up. It's now well and truly above 50%, about 56, 57% for Tether dominance. We can see significant outflows from BUSD. This is since minting has been essentially paused, and there will be no more BUSD minted by Paxos, who's the issuer. So BUSD has declined from about 16.5% to about 6% dominance now. USDC is still trading sideways between about 30 and 33%. It will be something important to pay attention to, in my view, over coming days to just assess whether USDC gets significant redemptions. And we're going to talk about this concept in a second, so hang on to that. Now, this chart here and this next one are both related, and these are, in my view, really important charts to track the really big picture. Is capital flowing in or out of this industry? So the assumption here is that generally speaking, people who come into the digital asset space will come in via the majors, Bitcoin and Ethereum, or they'll come in through stablecoins. That is the primary place that most capital, not all of it, but most capital will come through. So we can look at that and measure it by stablecoin supplies. If stablecoin supplies are growing, it means capital is coming in through stablecoins. And likewise, if it's decreasing, vice versa. And when we're looking at Bitcoin and Ethereum, there probably isn't a better metric to use than the realized cap. And that is that once people are acquiring these coins, it kind of becomes a real capital inflow when that capital comes off an exchange and is withdrawn or transacts on chain. So therefore, those transactions on chain, which is what creates the realized cap, we're valuing every coin at the time when it last moved. If a coin just sits on an exchange and is just churning around, is it really capital inflow or is it kind of trading? Once a coin is withdrawn, it's entered the space, it's in the market. So that's what this chart here is showing, the total aggregate market cap or realized cap, looking at Bitcoin and Ethereum realized cap plus stablecoin supplies. That's going to capture some 98% of all the capital in this space. It really shows where the vast majority of the wealth is held. And basically what we're looking at is where are we and what is the dominance relative to the total. So we're about 20% down in terms of realized losses. This is typical of a bear market. There's been about 20% capital outflow, and this is a combination of stablecoin redemptions and Bitcoin and Ethereum, literally losses, people who bought the top selling at a loss, and actually that's a capital outflow. So this chart here, which is actually the chart of the week and one that I would recommend people study and understand, because there's a lot of information packed in this one chart telling us about the overall capital flows in this space. So there are three traces here. One of them is an area chart, which is either green or red, for obviously inflows or outflows. That's the total. That is looking at how much this red bar is changing, this red line here, The total realized value in the market, how much did it change over the last month? The orange curve is how much of that was BTC and ETH coming from the two majors. And the blue curve is how much of that was stablecoins. So what we can see is that during the 2020 and 2021 bull, there was a huge amount of overall capital inflow into the space, and note that it was primarily driven by the major two assets. Stablecoins were a bit of a laggard. They followed, actually after the first sell-off, stablecoins were still growing during that period of time. We can also see that stablecoins overall were a much smaller portion through most of the bull. But what we can also see is there's periods of time where stablecoin growth was much larger and we had periods of net outflows coming from the majors. And interestingly, this is kind of starting to signal that the bear market was probably coming into effect. We can see that stables tend to lag this system. The majors are a lot more responsive. So we started getting capital decay coming out of this market as far as November 17. Right, so that's where we really started to see that massive decay, and really price was up at 48,800 by the time we were getting down to relatively low levels. Now, you can see that in the second half of 2022, we saw massive capital outflows again being led by the major two assets. Stablecoins were also in negative territory, seeing net outflows, but the majors are really where most of those losses were happening. And following the June sell-off and the FTX sell-off, these were our peaks in terms of total outflows so far. Now, February was a positive month. We had about 5.8 billion in net flows coming in, and that was primarily driven by the majors. In fact, we still had negative outflows of stablecoins. Much of this is driven by BUSD, by the way, which, as I mentioned, has entered redemption-only mode. Now, we have essentially reversed back to about 5.9 billion in net outflows per month at the moment. So this really here looks like a bit of a capital inflow, but the market isn't quite sure yet. It's actually looking a little bit like what we had back here in March 2020. You can see that we had a capital inflow followed by a capital outflow. Now remember, that doesn't mean that March 2020 is coming, but it does mean that we're not exactly seeing raging bull market capital inflows just yet. So it's one of those things to just understand the overall capital flows coming in and out of the market. This is a really powerful chart because it contains, in my view, the reality of money flowing in and out of the system. And if you do want to inspect this even further, you can always pull this up in Workbench in the top right here, and you can actually reconstruct this for just Bitcoin or just Ethereum or just stablecoins. And you can really break this down into many chunks using the concepts and formulas provided in this chart. Now, looking at the market's response to a banking crisis in the US, what actually happened? Well, we saw a bit of an outflow from exchanges for Bitcoin and Ethereum. These kind of longer term trajectories of net outflows from exchanges continue. We can see here for BTC and ETH, this is the exchange net position change. We have seen outflows, right? About 530 million worth has flowed out of the two majors over the course of the last week. What I would also do, let me just zoom this on a 2-year, note that it's an outflow, but it's also not post-FTX outflow. It's also not post-Luna outflow. It's an outflow, but it's not exactly the biggest outflow we've ever seen. So there is a preference towards buying them and pulling the majors out of exchanges, but it's not exactly, you know, pulling them out at the extent that we saw post-FTX. It's relatively modest. Now on the stablecoin side, I've actually got two charts here. The first one, if we were just to look at all stablecoins, or the top 4, you would say, boy, there's a lot of stablecoins flowing out. But it's important to remember that BUSD has essentially entered redemption-only mode. So this chart on the right-hand side, let me pull it back on a 2-year, this is showing stablecoins on exchanges excluding BUSD, and you can actually see we've got net inflow. So the takeaway from this, we do have net outflow of Bitcoin and Ethereum overall. So the market has a preference towards the majors, the trustless assets. What we're seeing is that stablecoins, which do have trust, are flowing in. So the overall view here on a spot market front is stablecoins in and majors out. That appears to be the current trend. Now, just note that the stablecoin in is about $2 billion a month. The majors out is about $500 million a month. So there's 4 times more stablecoins flowing in than majors flowing out. Still represents a bit of an uncertain territory at the moment. So just something to pay attention to. And that kind of covers the spot markets. Now, moving on and looking at the derivative markets to close out, just to kind of really capture a bit of what's going on. This is a bit more on the micro scale. We're going to start big and zoom in. On the open interest on the left and the futures volume on the right, both ETH and Bitcoin open interest is pretty much at multi-year cycle lows. We are basically back at December 2020 levels, right? Very, very low levels of open interest. Overall, it kind of shows that the market hasn't really woken back up yet. And we're certainly not seeing the explosive growth in leverage and speculation that we saw during the bull market. So still very, very quiet, and there's not much going on at this point in time. Trading volume, you can see the same. This was the post-FTX and Christmas lull, a very, very quiet period. We covered that back in week 2 and week 3. We have picked up a bit of volume, but it's still kind of 2020. It's still, 2022. It's still bear market levels. It's not really something to write home about just yet. And across both of these, Bitcoin commands about 60 to 65% dominance. You can see here during the quiet period that BTC and ETH actually converged on a volume front, basically meaning that 50% of the trade volume was Bitcoin, 50 was Ethereum. This kind of speaks to the fact that these assets have reached a level of maturity and liquidity that they can both be traded. But you can see that as the market kind of woke back up, that dominance reverted back to the kind of natural 60-40 that we tend to see across many of these dominance metrics. Now, on a more micro scale about what happened, I mentioned at the start on our price chart, we had that dip down to 19.8 and then a rally up into 24 now. I mean, it just the thing has certainly got some legs to it. What we have here is our total liquidations for Bitcoin on the left, Ethereum on the right. We saw a fairly similar on the wave down, on the trade down to 19.8K. We saw that long liquidations for Bitcoin were about 80 million over the course of a day, and for Ethereum is about 60 million. So a fairly substantial amount of people were caught off guard by that sell-off down to 19.8. But interestingly, we then saw a recovery where BTC had about 55 million worth of shorts that got squeezed out, and Ethereum actually had a lot more at 80 million in shorts that got squeezed out. So and then if we actually look down here, this is the funding rate spread. So this is the difference between the funding rate or the interest rate that traders were paying to be short Bitcoin or to be short Ethereum. The first observation, this is relatively small compared to FTX. So it shows up, it's a blip. It's a more significant event that we've seen over the last 6 to 8 months, but it's nothing compared to FTX in terms of scale. Let's zoom in on the 3-month. What you can see is note that the funding rate for Ethereum went far more negative. Traders were willing to pay negative 48% per year to be short ETH, and they were willing to pay negative 27% to be short BTC. So what that you can then see, we had much more, almost double the amount of short liquidations. In the futures market, this is really describing that the speculative interest, the people who are really punting on this thing, are essentially using Ethereum as a higher volatility, higher trade return asset. They're putting more speculative capital to trade Ethereum, and many of those folks, $80 million worth of them in this instance, got carried out as a result. So what we can see is that it was actually driven partially by a long squeeze on the downside and then a short squeeze on the upside of both assets. And there was a lot more short interest that piled into Ethereum, and they were actually the ones that got squeezed out the most. So it kind of shows you what's going on at a more micro scale. Now, the last chart, I'm actually going to pull this up on the full screen. So the last chart that I want to look at is bringing those two worlds together. We've got the world of our leverage futures trading, and we also have the world of our spot on-chain. And now I get a lot of people say, but hang on a second, so much of the trade volume is in futures, or so much of the trade volume is off-chain. Well, what we tend to see is if you think about that from a statistical framework, you've got two subsets of the market who are all interacting with, in this instance, Bitcoin. You've got people who are expressing their view about Bitcoin via leverage futures. You've got others who are expressing their view by self-custody and holding coins on-chain. And you've got others who are sending coins to and from exchanges to trade spot. So in all of these instances, we're talking about very, very large volumes of people and coin. Billions of dollars of Bitcoin flows in and out of exchanges every day. It's a significant amount. And actually the net flow is typically only a couple of percentage points. So on net, when you take away deposits and withdrawals, the net is about 5% at most of the total volume. So there's a lot coming in and out every day. So what we are actually seeing is two statistically significant groups, cohorts of Bitcoin traders or Ethereum traders, depending on what asset you're looking at. So those who are where somebody is making a decision to send their coins into an exchange, that will show up in metrics like SOPA, which is telling us their profit and loss. When somebody happens to be selling their coins at a profit, the funding rate tends to also be high because someone else is willing to go speculative levered long at the top. Likewise, during these sell-offs, someone is capitulating out of their coins. They're saying, get me out of this thing. I just need to send my coins to an exchange and be done with it. At the exact same time that somebody else is putting on a highly levered short. So these behavior patterns actually play out across both of these markets, and they're quite correlated because they're two subsets, statistically significant subsets, of people expressing a view about the asset. One just happens to be doing it via on-chain transactions and spot, and the other one happens to be doing it via a leveraged futures position. So if we then zoom with that context, let's zoom in on the last 3 months, similar to our liquidation chart from before. What I want to highlight here, so our funding rate in orange went very, very negative. It went into deep backwardation. That's what we were looking at before, where the funding rate spread blew out. Now, interestingly, actually, let me pull this back on a 1 year just to pick up one final thing. We are looking at short-term holder SOPA here. So people who acquired their coins in the last 155 days. So what was happening 155 days ago? Well, we hadn't quite had FTX blow up yet, but we were in a very quiet period and we were trading somewhere down around 19,000. Now, 19,000 is important because we didn't get down there during our sell-off. However, somehow, we look at all of this last 155 days. The only place during this sell-off that you could have possibly been underwater on your coins is if you had bought the local top. All of these coins back here and all of the post-FTX coins, these are all in profit. So SOPA should be trading above 1 for short-term holders because all these people are in profit. So the only people who could possibly be selling their coins and spending their coins on chain and locking in a loss are people who bought the local top. So what's important is that short-term holder SOPA traded down below 1, indicating that the people who are spending are local top buyers. Now, there's an exercise here. We have a dashboard called Spending Dynamics. I strongly recommend going and following up with this analysis. Go and have a look at Spending Dynamics, and you will very quickly see that the amount of transaction volume at the moment is quite quiet. And there's particularly not a great deal of older coins on the move. Some of them are, but for the most part, coins are the chain's pretty quiet on the whole. So therefore, let's just, for simplicity's sake, most investors on chain are not doing much. Those who are doing a lot are the short-term holders, and those who are doing a lot are short-term holders who are locking in a loss. So what we're seeing is that on that sell-off to the downside, we had the main people who were spending were local top buyers. And at the exact same time, somebody else was going levered long and paying negative 25% to be short Bitcoin, both of these at the exact wrong time. That then gave rise to a significant short squeeze. So it's kind of interesting where you can see these two markets playing off against each other. And when you kind of isolate these things, you're saying, okay, where were the investors who are selling at a loss? Well, they're top buyers. Top buyers are the most reactive, most responsive. They're the most likely to panic when price goes below their sell point. Then you get the market go into backwardation. There's a lot of conditions there for a short squeeze, and that's exactly what we saw play out. People are willing to go more speculative short on ETH because they think this thing's going to zero, and they all get squeezed out. So you can see how many of these factors play out one after the other. So thanks for tuning in for that session, folks. Hopefully you found that useful. For your homework, I do recommend going and checking out both our realized profit and loss and our spending dynamics dashboards. They will give you a bit more information regarding that last section we were talking about. Certainly in terms of assessing what how dormant the chain is, so you can kind of isolate the spending. It has been a pretty consequential week. We've had a few of these over the last, let's say, 24 months. So, you know, what we're basically seeing is there is a transition towards self-custody of trustless assets. We are seeing a bit of nervousness in the stablecoin space. But overall, it is a time of being cautious because there is a lot of moving parts. There's a lot of very big, significant events that are playing out. So it is a time to really just be quite cautious because it's a lot can change, as we discovered in just a handful of days. So hopefully you found that useful, and I will see you in the next one. Cheers. Hello everyone and welcome to your Glassnode video report for week 12, 2023. So we are looking at Bitcoin shifting up a gear this week. It has outperformed pretty much everything. Seeing an extraordinarily strong performance this week, especially considering the absolute turmoil and chaos that we're seeing in the traditional finance and banking sector. So in many ways, Bitcoin is doing essentially what it's here to do, which is survive during adverse conditions. And what we're going to look at today is a couple of metrics that help us kind of describe this rally, put things into a bit of perspective, and try and answer really some key questions. And actually, there's a bit of a topic here we'll touch on in just a second. So this week, Bitcoin has rallied 35.8%, which is, as we're about to find out, one of the largest single week rallies that we've ever seen. And we'll look at some workbench charts that can help us actually plot this out. Now, this obviously comes against a backdrop of some pretty challenging financial conditions. We've seen bank runs, we've seen bank failures, we're seeing, challenges in European markets and Credit Suisse, and there's all sorts of issues going on in the traditional finance system. Liquidity doors need to be open, things need to be patched over, and Bitcoin continues to bring in blocks one by one. Now, when we see one of these very powerful rallies, the key is, what are the questions that we want to answer here? And in many instances, we want to understand, does the rally have supporting health behind it? Do we have the network adoption to kind of demonstrate that really is happening? Do we have profits being taken? And if those profits are being taken, who are they being taken by? Is it the smart money? Are they people who recently bought? Who's that kind of characteristic type who's taking those profits? And the other one is looking at where are we in kind of the macro cycle? We look at a lot of these metrics. Are we undervalued? Are we overvalued? Are we neutral territory? Trying to find our way around this puzzle of whereabouts are we in the Bitcoin market cycle after such a powerful rally off the bottom. Now, what I do actually want to ask you all, if you do have typical questions that you come into this space for, I mean, at the end of the day, what on-chain analysis, at least for me, to me, it's a bit like having X-ray vision. We can see what other people in the market as a whole are doing. So we can kind of see what's going on around the world, how people are actually reacting and behaving to these market events. But obviously, I stare at this data all the time. So I actually want to ask you, what are some of the questions that you want answered? And what I can do is essentially look at those questions, try and understand what it is you're looking for in this space, and help you find the correct dashboard, the correct workbench, the correct newsletter, the correct material to help you really answer those questions. Because that's what I certainly use on-chain analysis for. I have a question, are the smart money taking profits? And I will then go and find the metrics and, build the dashboards to help people understand exactly what it is we're looking for. So this is what me and my team are looking to do. So if you do have questions, particularly as we come out of a bear, as we, enter into some kind of a more exciting market, do give us a bit of a view on what the questions you have. We can help you answer them, and we will try and focus our content and our dashboards that we're building to really help you out on that front. Now, as usual, before we get started, please do give us a rate, a share, and a subscribe. I know you all do, and it does make a big difference. So anyway, let's get stuck into the analysis. Okay, so as I said, we're going to start by looking at a price chart. What I've been trying to do with these sessions is, rather than just looking at the bar candlestick chart, which, okay, that's all well and truly and fun, let's actually have a look at something that's a little bit more interesting, particularly during large rallies like we've got. Now, here what I've plotted out is we're trying to look at the 7-day price performance. And what I've used here in Workbench is the %_change, which is going to give us of price on a 7-day basis, present the percentage change, both positive and negative, over a 7-day rolling window. Now, what you can see is we form a bit of an oscillator. Obviously, during bull markets, we get more positive price appreciation. During bears, we get more negative. But you can see that this thing is essentially oscillating. And the very, very odd occasion do we get these very, very high spikes like we had this week, 35.8%. Now, what I've also used here is a combination of our value at function, which is going to give me the current value, because I care about what the current value is. But I've also used our cumulative max function. And what this is doing is saying, over the last 7 days, give me the peak performance. If you just put this in as default, it will give you the all-time high, the cumulative max, the all-time high. If you do it on a 7-day window, it will show you the highest value over the last 7 days. So what I'm doing here is saying, give me the highest value of our price performance over the last 7 days, and then return the current value. And you can see this green line here is quite nice in that it helps line up with all of these previous peaks. Now, what I've also used here is an if statement. So if our current price change, or at any point in the past, if the 7-day price change is greater than our current 7-day high, return M1, which is going to be these orange bars that snaps onto price, else return 0. So what we can see here is these orange lines are then going to show up and show me all of the days, or all of the weeks, sorry, where we've had better 7-day performance. And as you can see, there's really not many of them. And what I would highlight is that the vast majority of them are actually back here in the kind of 2013, 2012 era, which, as I've said before, we probably don't need to look at that with too much detail. It was just a very different beast back then. So when you look at our recent performance, you can see that there was one at the very, very beginning of the 2016 bull market. But most of them, 2017, 2019, and then also 2021, most of these events typically happen in raging bull markets, actually near the end of the trend. So it just gives you a bit of a perspective on how powerful this rally is. It doesn't mean that that necessarily means that, oh, it's all over and done, because we've clearly had examples of this in the past, but we typically see this level of explosive weekly price performance during late stage bulls. So it does give you a bit of a context that there could be a bit of a turning of the tides, as we've been discussing over recent weeks. So the second question, when I see such price performance like that, the first thing is go, okay, it may be a little bit cautious. We don't see these events very often. So generally speaking, it's probably unlikely that it continues to just go in one direction, right? That's very, very uncommon for markets. So what I really want to look at here is, do we have the underlying strength? I want to explore, does the market really have the fundamentals to back up this rally? So now we're going to look at some on-chain activity metrics. Now, you'll know if you've been watching this channel for some time that we love our momentum metrics. These are really, really nice ways, because daily activity, you can see in the background here in the orange, this is looking at the transaction counts. Down the bottom, we've got new addresses and new entities. You can see that the actual daily traces for all of these are very, very noisy. They're kind of all over the place. So what we like to do here is put a monthly moving average here in the pink, and then in the blue, we've got our yearly. And it's just a really, really simple way to clean up the data. And we say, do we have more monthly activity than our yearly baseline? And as you can see, we have an extremely nice bounce in terms of our transaction counts. There is more transaction activity going on. In terms of our new addresses, we also have a very, very healthy uptick. And then in terms of our entity adjusted, our clean view, our best estimate of new users, we also have a nice healthy uptick. So most certainly what we appear to have is a strong rally, and we actually do have adoption growing behind it. We are seeing more users, more transactions, more activity going on chain. And we can back that up by saying, okay, all of those things, people could be churning new addresses, and, you know, in theory, it's a bit of a gameable metric. It's hard to game, but it's not totally gameable. But at the end of the day, if we actually have people paying transaction fees, that's assigning a cost. There is a true cost associated with playing that game. Now, if fees are very, very low, then someone can do that. But in the instance where we actually do have true adoption, we will typically see our fees and pressure start to build in the fee market. So what we've got here is a 2-year Z-score of miner revenue from fees. So what this is basically looking at, when it's positive or red, it means that we are above the 2-year average in terms of overall activity by some amount of standard deviations. When we're below, it means that we are statistically below that long-term or that 2-year mean. And as you can see, we have recently flipped into positive territory. So what I would impress upon you from all of this, we certainly have what I would consider a healthy uptrend. We have an uptick. We're above the yearly for all 3 of these metrics. We also have congestion and fee pressure building in the fee market. But what I would also note, we're not at all-time highs. We're not ripping higher. We're pushing higher. It's moving higher. We're just getting into positive territory, but we're not exactly exploding higher yet. So that's a positive thing. It's not a negative thing, but it's also not a raging bull thing. So we kind of combine these things together and say, okay, so we have price performance that typically happens near late stage bulls, but we don't yet have the adoption that looks like late stage bulls. So you can kind of start putting these together and saying we could be somewhere, you know, in a bit of a middle ground, kind of a bit of a transitional phase, or the market seems to be, you know, kind of waking up from a bit of a, you know, maybe a bear market sleep, for example. Now, we're looking here, who's the beneficiary of higher fees? It's going to be miner revenues. So what we've got here is a very similar model. Here we've actually just got the daily. This is the miner revenue, so all in USD, how much is being paid to miners per day across the whole network. In the blue, We have our yearly moving average. The pink is the rolling sum. We can kind of leave that. We're not going to focus on that one today. The key thing I want to pay attention to here is the level of where we are. So miners have finally seen about 26 million per day in revenue. This is a nice uptick, and it's now above their 1 year average. Miners must be breathing a big sigh of relief. It's been a very challenging bear market for them, so it's good to see that start to pick back up. But typically speaking, when we break above this yearly moving average, we saw it back here in July 2021, right before we rallied up to all-time high. We saw it back here in, I think this was October or November 2020, before we had the bull market run. We had it back here in 2019, as we rallied up to that 14,000 peak. So what you can see there is we've got this rally that also faded back here in November. We had 2019, which was faded, and we had the full-scale bull. So typically speaking, these describe these kind of transitional points and inflection points. So we typically see these breaks above yearly momentum levels, and that's why we like to use them. Actually, they're a really simple tool to just gauge, have we seen a shift, and is that shift meaningful? And in this instance, yet again, we do have another meaningful shift. So that's kind of answering at least part of the question of, do we have a bit of, on-chain momentum? Is there kind of activity and adoption to support the rally? And you could argue that there is a case to be made there. So the next question is to say, okay, well, whereabouts are we in the cycle? Because we're clearly not at 15,000. We're clearly not at 18,000 anymore. There's been a fairly substantial rally from that point. And when we look at things like the MVRV, this is a fantastic metric. It really is a bit of an all-weather tool, and absolutely fantastic for just understanding where you are in the cycle. So just as a reminder, we'll quickly look at this in a second. There's a whole dashboard for both Bitcoin and Ethereum focused on the MVRV, including a report where all of these charts are defined. So if you want more details, I strongly recommend that you jump into those MVRV dashboards. You'll find them under either Bitcoin or Ethereum under the profit and loss section in Glassnode Studio. You'll also find links in the description below. Now, what we're looking at here, this is what we call the deviation bands. So we're trying to bring a bit of statistical rigor into trying to work out where on earth are we in the cycle. This blue line here, this dark blue line, is the all-time average for MVRV. Let's just zoom out on the full-scale history so we can see this thing. This is the all-time running average of MVRV. And what you can see, during bear markets and late bears, early bulls were underneath it. During late bulls and early bears, we're above it. So it's kind of really defining that macro transition between the two. Now, what we've also got in the green is a -1 standard deviation, extremely stretched away from that kind of long-term average. And we've got one to the upside as well, when we're just screaming higher and we're just a little bit too far to the upside. So naturally, we can use those because MVRV is a derivative of realized price. So we can therefore calculate a pricing model, and that's what this curve here is showing. So what you can see is we're coming off the level where we were in the extremely underneath the all-time average. We were we deviated quite a bit. And you can see that we typically intersect this in 2018, back here in 2015. We don't spend much time down there. It's a very unlikely scenario. On the other hand, trading between blue and green, we typically spend something like 55% of all Bitcoin history in between these two. There's about 5% on this side, there's about 10% above the red, and the rest is in between, about 45% above here, and something like 50% in between the blue and the green. So we're kind of back to neutral territory, and we actually explored this a couple of weeks ago. Now, just to kind of bring that to another level, the green line here and the orange line here, this is where most of Bitcoin spends its time. Something like 45 to 50% of all trading history is between this orange curve up here and the green line. And as you can see, we are breaking above that level. So this is between the plus or minus 0.5 standard deviation. So in statistical language, we're just not very far from the average. We're kind of on the average now. It's not kind of overly exciting in either direction at this point in time. We are in neutral territory. We've kind of entered this zone where we're not extremely stretched to the downside. We're not extremely stretched to the upside. It's essentially reverting back towards the mean. We are literally reverting back towards the center. And you will notice this on several metrics. This is the MVRV momentum. So it's momentum, but just converted into an oscillator. Note that we are literally at the point of, well, I mean, we've crossed over it now, but we are essentially at neutral. We have crossed over that central position. Now, this metric in particular, again, you'll find this in the MVRV dashboard. This is a really powerful tool for those who are just looking to understand the macro cycles. So think about this. At bull market tops, what really defines them? Well, you have a lot of new buyers who buy the top. You've got a lot of old money who sell the top. You've got lots of coins with a very, very high cost basis. So thus, any price fall below it, you get a top-heavy market. Let's say a bunch of people, I don't know, maybe bought price at 60,000 perhaps, and then price trades down to 30,000. There's a lot of people up there who are trapped underwater and seeing a very red number. That event will cause MVRV to fall very quickly. And when it does, 2017 top, look how quickly this reverts to the negative. Look back here in 2021. Look how quickly this reverts to the negative. In fact, this went negative before the sell-off had even finished, showing you just how many coins were trapped, sold up the top, high cost basis, big red flag, dangerous. The exact same thing is true on the other direction. Let's look here at 2018. A huge amount of capitulation took place. People dumped their coins following the sell-off. Well, somebody had to buy them, and a small price appreciation up from 4K to 5K pushed all of those coins back into profit. Here we are in 2015. A small rally to the top of the range pushed all of those coins back into profit. Here we are, coming off the FTX lows, it's pushing many coins back into a profit. This metric is fantastic at tracking where you've got those very top heavy, which is bearish, or bottom heavy, which is bullish, because you've essentially had a huge transfer of coins to new buyers, whether they're long-term holders who are buying, people who have high conviction in the bear market, or people who are here because they saw it on the news and they're very excited and they're buying their first coin. Typically that happens near the top. So this metric's really good for looking at those cyclical changes. And you can see here, we're essentially crossing over the neutral boundary. So the last topic we're going to look at is looking at taking profits, right? Who is taking profits, and are people taking profits? Because this is another question that, as we get these powerful rallies and the higher the price goes, the greater the incentive becomes to sell. At some point in time, someone's going to look at the green in their portfolio and say, you know what, I like that number, I'm going to sell a little bit. So this starts to happen as bull markets play out. You've also got people who are trapped from the previous cycle who are just waiting for their money. No, give me my money back. I just want my cost basis back. So on this chart here, we've got 4 different versions of SOPA. We've got standard SOPA, which is the whole, all transaction activity. There's no filtering. It's just the full suite. You can see that we've got adjusted SOPA. This is removing those relay transactions, coins that go from an exchange to someone's wallet and then get transferred again, taking out those kind of relays, non-economical transactions. We've got our cleanest version, which is entity adjusted SOPA, which basically takes out all the exchanges, all the internal wallet clustering, all that kind of stuff. It's very, very clean. And then we've got our short-term holder SOPA, which is a variant of that, that's just looking at young coins, coins younger than 5 months. Now, what you'll see is that all of these have a very, very similar pattern, although some of them are a bit sharper than others. For example, short-term holders, their largest losses occurred during the June sell-off, and their losses actually got less and less and less. This is a nice positive divergence. Even though price was going lower, the magnitude of losses by people who were recently buying were declining, and that's because people who were recently in the market were actually buying down here at these levels, which we've talked about over recent weeks. If we look at our full market, and actually our adjusted as well, FTX was where the biggest damage happened, this enormous, massive sell-off, but it has since started to recover. And both of these have seen a nice push above 1. Now, just a high level here. We talked about this last week. The short-term holder SOPA was the correct tool to look at last week. We saw profits get taken, the most significant since the all-time high. So people who bought recently down at the lows took profits. But also 155 days, given where we were, the only way you could possibly have coins that were underwater is if you bought the local top. Well, these folks had coins that were at a loss. So what we're seeing here is that this undercut of 1 and then a rejection upwards is actually a very, very positive sign. People who bought this local top after realizing profits, people who bought this local top were flushed out at the bottom. This happened to actually also be the 200-day moving average and the realized price. So people sold their coins that they recently bought at the top at the lows, and then we had a very powerful bounce forward, also powered by short squeezes, liquidations, and all that stuff. So you can kind of see overall, the big picture is this long-term uptrend. We've got a long-term uptrend in all of these metrics. And this is showing that there is less losses over time. The capitulation event has largely happened, and we've had that recovery. We had the first profits get taken. We had the correction. People who bought the top of the correction sold the bottom of the correction, and now we've pushed back into profitable territory. This type of behavior, and whilst we don't know if this is a bull market, we just don't. And we don't, it's probably, there's a transitional period. These things take, many months to years to actually play out. This pattern, on the other hand, is typical of a not bear. So we typically see in a bear, you will get rejection at a value of 1. I want to sell at my break-even price, give me my money back. I'm selling at my break-even price, give me my money back. Here, I'm taking profits. I sold the bottom, and up we go. So if you start to see these retests of 1 and it's healthily maintaining on a SOPA metric, it's typically a sign of people actually not selling to get their money back, but stepping in and actually buying their cost basis, starting to see value coming back into the market, seeing price come back, and you start to move into that buy the dip type mentality rather than the sell the rip mentality we see during bears. So the last thing that I want to touch on is actually our realized cap HODL waves, because that question we just answered before is, are people taking profits? The answer is yes, but we're then seeing that kind of buy the dip mentality step in. So the last question we want to ask is, who is actually taking those profits? Now, as we saw, all of those SOPA variants were essentially kind of telling us the same story. It's kind of everybody. We could look into long-term holders, but I actually directed to the Recon Chain report. We cover a little bit more